and fun growing a business. I feel it's a real privilege. And I started my business officially at 18, but I think I knew I wanted to do it very differently from about 15. But I'm sure it's, if you're surrounded by it, it feels very natural. So yes, it's fun.
And it started how? You started by you went to Florence. It was in Italy, and you started handbags.
Yeah, so I knew I was actually given a handbag by my mother when I was about 16, one of her old handbags, and I remember how it made me feel, and I think fashion is fascinating for the mood-changing, the confidence-boosting aspects, of the sort of tribal aspects of what fashion does. And so I went at 18 to Florence, knowing that was the home of leather goods, which is what interested me. I just wanted to learn, actually, and be surrounded by craftsmen who, making things is important, and that's going to be very interesting, I think, over the next sort of 10 years. I think the onshoring of craft and manufacturing is going to be fascinating, actually. I watched the offshoring. I literally saw it, and I think we're going to be seeing that coming back to local. We have to. When we're all looking at our objectives in terms of carbon, proximity is going to be key.
The moment news breaks, no one covers the world like Bloomberg.
The return to pragmatism is really that everybody's in line. The government, the enterprises, the people, in pushing this economy. It's like a cycle of renewal.
Big tech layoffs rolling in. Spotify, the latest to tighten its belt, with plans to cut 6% of its employees.
Is the economy unfolding as you thought it would?
I think the economy is responding to work that the Federal Reserve is doing.
Bloomberg, your global business authority. Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think the markets have been mispricing the Fed for a while now.
We don't think the Fed is done.
How high does the Fed need go? It needn't go too high, in part because of the confidence it's instilling in investors and the public.
Effectively, I think what we're seeing is that things are actually improving around the world.
Maybe nothing happens and we just have a plain run-of-the-mill recession. That's my bet at this point, if we have a recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Happy Valentine's Day.
Oh,
it's a beautiful thing. That's enough of that. CPI Day from New York City. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Let's get straight to this market. Equity futures up 0.2% on the S&P 500. TK CPI just around the corner. A lot of people expecting this one to stay somewhat elevated.
Yeah, I think the whispers are somewhat elevated. I'll let McKee decide what that is. But, the way the market closed yesterday, I think maybe there was a swing back off of Friday where people are saying, okay, it's elevated, but we're all going to live and move forward. That was sort of the 2 p.m. angst yesterday.
Rallied into the CPI report. Big day of gains yesterday, and at least we've said this a few times this morning, but last week was the biggest week of losses we've had on the year, and we wiped them all out in yesterday's session.
You said this yesterday, that the fact that the biggest weekly loss of 2023 was 1%, it basically gives you some sense. And heading into CPI, how much is this market poised for some sort of disruption? And I say this particularly with services sector inflation and where that comes in, given some of the earnings that we've seen from consumer-facing companies that keep delivering upside surprises, particularly vacation types of
The chairman of the Federal Reserve has sat there twice now and said the disinflationary process has started.
In goods.
Does this morning's data contradict that or support it?
That's a great question, because even in goods, he said the disinflation, he clarified the second time, disinflation process has started, but just in the goods side, the services side, we haven't really seen it yet. Maybe, we'll see. But we will get a sense of whether we start to see some of the goods side reinflate at the same time that services side sector continues to be really strong. And I say this, Marriott just came out with earnings. They beat expectations. We have seen this again and again.
And Tom, Coca-Cola as well. Decent numbers from them. PepsiCo was it last week, and Coca-Cola delivering a similar story. story.
I'm doing the math right now, John. It's, the 10-year track record is what these two arch competitors face at. And I'm sorry, PepsiCo's clean Coke's clock. I mean, there's no other way to put it. I look at it, and it's all great. Organic revenue's up. Their free cash flow is absolutely unacceptable. And many, many other, you look at the Disney focus that we had.
Yep.
Bob Iger, timeout chair. Okay. Nobody's doing that with Coke, and I've never understood it. They did not deliver on free cash flow.
The stock is up in a pre-market.
Yeah, everybody disagrees with me, but I'm just saying on a 10-year per year basis, I got Pepsi at 11.6% and Coke at 8% something.
As soon as you said that Pepsi is cleaning Coca-Cola's clock, I immediately Googled who owns Tang, and it's Mondelez.
So no, Mondelez, they send it to me. They send me a case every 90 days.
No, he's not,
where are they?
He's got a contract that says he can't speak about Mondelez. Right?
Clearly, I mean.
He can talk about Coke and PepsiCo, just not Mondelez. Equity futures right now up 0.2% on the S&P. Going into CPI a little bit later. Yields come in about a basis point on a 10-year, 3.69. Keep going back to yesterday's session to see the 2-year Tom at 4.55. That was something. Well, that was something.
Coca-Cola's there is a distraction, but John's absolutely right, folks. It is about the fixed income market. The 2-year yield, 4.50%. We saw for a brief moment here on BTMM Go, the acclaimed Bloomberg Terminal short paper function, John, 5.02% as an ask on the 6-month piece.
Have we got a countdown clock, Tom? We 87 minutes.
To what? AC Milan and the Tots?
I'll start that clock after CPI.
Okay, thank you.
87 minutes away, Lisa.
That's exciting.
And we are going to dig in 87, or it's 86 minutes now. 8:30 a.m. we get U.S. CPI for the month of January. We are going to be looking at the underlying components pretty carefully, not just the year-over-year composition. Month-over-month is more important than year-over-year. How much do we see some sort of dramatic response in markets? And this really is my question. How fragile is the rally that we've seen year to date to some sort of upside surprise in the CPI print that we get later this morning? Today, we also get a host of Fed speak, including in, I believe, if we get the countdown clock, what is it? It is 173 minutes, 153 minutes until Tom Barkin comes on at 9:30 a.m. on Bloomberg Television with Jonathan Farrow, and of course our own Michael McKee. Also, Dallas Fed President Lori Logan at 11, Patrick Harker of the Philly Fed at 1 p.m., and then of course we get John Williams of the New York Fed at 2 p.m. What do they say? Is this just, basically groupthink? We're going to raise rates 25 basis points and another 25 basis points. The market seems to be in some sort of agreement. We're data dependent. Or do they come out and give some sense of a willingness to go even more restrictive, that they're not yet restrictive in the face of inflation that does seem to be persistent? And at 1:15 p.m., we get President Biden speaking about a whole host of issues in Washington, D.C., perhaps chips, the Inflation Reduction Act, especially in light of what we have been seeing with respect to international competition with Europe. But you raised this really good question, John. What's he going to say about Lael Brainerd? How is that going to inform both his potential run in 2024, but also a strategy for a Federal Reserve where she was a more dovish voice?
The clock is up, Lisa. I can see it now. 1 hour and 24 minutes away. Just looking at it on the screen. Bramo, thank you. Looking forward to that address from the president a little bit later. Joining us now is Anna Han of Wells Fargo. And Anna, I'm not going to bury the lead. Your research yesterday, first line, the bear market is over. Anna, let's go straight there. And thanks for being with us. Why is the bear market over?
When you look at the signs in the market, you're seeing the credit spreads compress. Something that's pretty rare in this time when the market's expected to fall into a recession. You're also seeing that the volatility has been pretty contained on the equity side. These are the kind of factors we look at, and then we point to what everyone loves to point to, which is a strong labor market and declining CPI or inflation metrics. These are all lining up to be not the bear market that we saw last year. So that really explains the first part of our title of our new note.
And if we get a breakout on this, if we get some form of, a movement from a bear market to who knows what, right now the hope and prayer day-to-day basis has been a short squeeze. We may see that this morning with a constructive CPI report. When and how do we get beyond a short squeeze?
No, you're absolutely right, Tom. What's been leading the market is really the stuff that has not performed well, the unloved, very highly shorted names. They had a very strong bounce to start the year. But to see this rally extended, we really need to see leadership change from not just a bounce in what had really underperformed and was having sort of this, dead cat bounce, as we call it. But what we need to see is actual sustainable earnings growth driven leadership. And for us, that's not as easy to find in the large cap market. Perhaps we like to size down and look more in the mid cap space, and we think that we'll find some better undervalued growth opportunities there.
Do we underestimate, particularly if we get some form of persistent inflation, what nominal GDP into revenue growth is going to be? Coca-Cola just had revenue growth in their fondest dreams they'd never admit to. Granted, free cash flow wasn't there, but organic revenue growth is an act of God. Is that the great underestimation of your bull market call?
Absolutely, the inflation and how long the CPI can really persist or perhaps stay longer than what the market is currently pricing in, and therefore, in a way, push out future rate cuts. These are all things that we have to consider when we think about revenue growth and earnings growth, because especially in this kind of environment, when we were looking for positive signs, we don't want to fall for that honeypot of a trap where things will seem to be growing and then only to find out that this was more of a inflation-driven metric rather than actual volumes increase in sales combined with actual consumer strength. So these are all the signs that we're looking for as well when we look for what could possibly turn our scenario into an extended bull market.
This is a really frustrating bull market, I imagine. You said that it's a bull stuck in traffic. It sort of gives you the sense of frustration that everybody feels with. Even if you get some gains, it's going to be a pretty motley picture in terms of which sectors and how much things actually go up. So can you give us a sense of the dispersion you expect this year, akin to what we saw last year in terms of sectors outperforming and underperforming?
Well, I think last year the dispersion was quite great, particularly in the sectors that traditionally have done pretty poorly. Think about the traditional defensives. Now you come this year, and I think that leadership has changed again. You aren't seeing these typical defensives being the leader. You're seeing them quite lagging the market in some senses. But we think that actually is an opportunity to pick up some defensive exposure, particularly more in the pharma space. It's had a bit of a rough start to the year, but at the same time, we're not ready to pour on the risk in our portfolio. So we like something that can act defensively, has a little bit of an improved valuation, an improved technical standpoint, but also, like we said, has that more defensive earnings growth aspect that can plow through, especially if we see even further slowdown in earnings growth later this year, if rate cuts have to get pushed back, if tightening starts to weigh and we see the delayed effects of those monetary policy changes.
Just real quick here, Anna, how do you view what happened with January, given the fact that unprofitable tech companies performed the best of anything?
I think the main thing here, Lisa, is look at the cost of capital. This is what we continue to emphasize with our clients. There's two aspects here. If you look at the drive of cost of capital, the 10-year yield coming in 40 basis points to start the year, that kind of move has to, in a way, be reflected in the equity markets, and seeing that rally in the more growth-oriented sectors, especially the cyclical sectors, that's actually a healthy sign to us. It's telling us really equities and rates, they are still working in a way paired off, like teeter-tottering like they're supposed to. On the other hand, if people are concerned really about the fundamentals having been the main driver of equity returns last year, then people continue to be concerned about fundamentals who aren't convinced by what we've heard in this latest earnings season. That could be a reason why to continue to stay bearish, but that's not our base case right now.
Anna, it's a pretty nuanced call, and I appreciate the clarity this morning from you and the team. Anna Han of Wells Fargo, working alongside Chris Harvey, making a call in the last 24 hours that the bear market is over. We are about 1 hour and 20 minutes away from inflation data in America. Lisa mentioned we'll hear from the president a little bit later. We may also hear from the president on Lael Brainerd, the current vice chair of the Federal Reserve. Our team here at Bloomberg reporting she's set to be announced perhaps as soon as today, maybe later on over the next week, as the National Economic Council Director, replacing the outgoing Brian Deese. The other piece of news we got in the last 20 minutes or so is the first official challenge to the former president, Donald Trump, to make a bid to become president. Nikki Haley, former UN ambassador, South Carolina governor. Get excited, Tom. It's time for a new generation. Let's do this. Out on Twitter about 20 minutes ago.
I think we got to get used to the new generation angle. It'll be fascinating, particularly with what President Biden does. But that seems to be the huge issue. In her 50s, DeSantis is 44.
So this is the first official challenge. Then we're thinking about DeSantis, Pence, maybe Pompeo. Trump's
7,
already in there.
10.
Hey, we're going to find out.
Lisa, are you thinking about it?
9, 10, 11.
The fear is it going to be a circular firing squad for the Republicans?
That sounds brutal.
Is that what happened last
You
time?
frame it that way.
Well, no, but like this is the whole question of whether people cancel each other out and then you pave the path for former President Trump, right? This is really the question.
If they dilute the field.
Thank you. That's a more graceful way
The
of saying
support
it.
for the former president is going to be so sticky through the primaries,
Correct.
you'd think.
Yeah, so it's going to make it difficult.
We'll talk about that in just a moment. David Balin in the next hour, the CIO and Global Head of Investments at Citi Global Wealth, with inflation data coming up at 8:30 Eastern Time.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. NATO Secretary General Jan Stoltenberg says that Russian President Vladimir Putin is far from talking peace and is preparing for more war.
We see no signs that President Putin is preparing for peace. What we see is the opposite. He is preparing for more war, for new offensives and new attacks. So it makes it just even more important that NATO allies and partners provide more support to Ukraine.
NATO defense ministers are meeting in Brussels this week. They'll discuss spending targets Wednesday. Bloomberg has learned that Turkey plans to resume stock trading Wednesday. The Istanbul Stock Exchange suspended trading February 8th, 2 days after a pair of powerful earthquakes jolted 10 provinces across Turkey's southeast and Syria. The quake killed more than 37,000 people across the region. Ford Motors is laying off about 11% of its workforce in Europe. It's the latest sign of industrial disruption caused by the automotive sector's shift to electric vehicles. Some 3,800 jobs will be cut, most of them in Germany and the UK. The carmaker has reduced ranks in the region by 35% in the last 5 years. Global news powered by more than 2,700 journalists and analysts. I'm Lisa Mateo. This is Bloomberg.
Countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Chairman of the Federal Reserve is obviously an important job. What do you do to relieve the stress other than interviews like this?
As you know, I like to ride my bike.
I say, is that safe, riding a bike?
It's safe if you stay on the bike.
From the world of politics to the world of business, Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg. Wall Street prepares for the latest read on inflation.
There's a huge amount of uncertainty out there.
We're going to get some lumpy numbers. Will annual rates continue to fall?
If we get a hotter print, how much does that really take some of the momentum out?
Instant reaction on Bloomberg Surveillance.
The data have come in stronger than expected.
Or are they literally making it up as they go?
Plus an exclusive interview with Richmond Fed President Thomas Barkin.
It just makes sense to steer more deliberately.
February 14th might have something to say about that.
Inflation in focus today on Bloomberg.
We are still
far from achieving price stability. And I expect that it will be necessary to further tighten monetary policy to bring down inflation down toward our goal. Doing so will likely lead to subdued growth in economic activity and some softening in labor market conditions.
Still waiting for that softening in the labour market based on the official data, claims, and that blowout payrolls report from a couple of Fridays ago. That was Michelle Bowman, the Federal Reserve Governor. Tons more Fed speak coming up later. We'll touch on that in just a moment. Equity futures right now up 0.2% on the S&P. 1 hour and 12 minutes, 47 seconds away. Thank you. Just working off the clock. Yields come in a basis point on a 10-year, 369. Your 2-year yesterday, nicely through 450 at 455. It comes down just a little bit today, and some dollar weakness off the back of that comes through. Euro dollar 107.50, Tom. We're positive there about 0.25%, and futures positive too by 0.2.
We get lucky right now. What we do is we book guests. We've got a wonderful team, and they're working sometimes on the 10-minute or at the length of a 1-hour basis, but sometimes they're 3, 4, 5 days ahead of dragging onto the show really competent people. Right now, with this announcement of Lael Brainard moving to the White House pending, it is perfect to speak to Heidi Krebo-Redeker with the Council on Foreign Relations, Adjunct Senior Fellow, but far more than that, somebody with a beltway understanding on her path from Dartmouth and LSE to different services for our government. Heidi, thank you so much for joining us. I was talking with John and Lisa about the Brainard I first knew, with David Riker writing about trade and labor policy, the effect of American multinationals. What a perfect time to have someone like the gentlelady from Wesleyan join the White House team because of China. What will Brainard say to the president about China?
Well, first of all, thanks for having me on the show. And Lael Brainard is a huge win for the White House. You know, as you were talking about earlier, she has she's experienced. I know that there's no steep learning curve. She has incredible experience on domestic and international, White House, Treasury, academia, and she knows all the people around her. So she's worked closely with Jake Sullivan. She's worked closely with Janet Yellen, and on China, I think she has a great depth of experience, and that's it's important because this NEC has sort of merged with the National Security Council in how it's looking at national economic policy.
What does that mean for the Treasury and the role in formulating policy, Heidi?
So I think that if Lael is announced, and I think she is likely to be later today, she and Janet Yellen go way back. So any bumps in the relationship with Treasury, I think she could easily smooth over. I mean, this is it's a big position. It's a you know, stepping in to be the head of the National Economic Council. It's a very powerful role. And it is a convening role. So she will be sitting, you know, advising the president on both domestic and international economic policy. I think that it's a good move for Treasury. It's a good move for the White House.
That said, some people are looking back to 2021, where there was some political interference alleged as to why the Fed didn't raise rates sooner. That perhaps if the Fed chair, Jay Powell, had been renominated, he would have had the conviction to go forth more quickly. Do you think that the disruption in leadership may cause some sort of ongoing hindrance to the Federal Reserve if someone isn't nominated to replace her in the near term?
So I think they are going to have to find a good replacement and really, you know, a heavyweight, because this is this vice chair position. It's not just Lael. It's not just any governorship. I mean, we've had Stan Fisher there, Janet Yellen in the past, and I think that they will go probably centrist. So a heavy hitter and someone centrist, not someone really necessarily from the far left.
I'd love to get your comments, Heidi. We're talking a lot about Lael Brainard, but we also just talked about Nikki Haley announcing her run. And I am curious whether you really see this as an incredibly crowded field that makes it more likely that former President Trump actually has a more legitimate chance at being the Republican candidate in 2024.
So I think, I was a little surprised that she announced with the video just a few moments ago, Nikki Haley. But it's a very crowded Republican field, as you noted. And we'll have to see. I think, the big concern is, does the field divide itself so much that it enables, former President Trump to really have a clear path to be the nominee? I don't know. But I think the tendency in the Republican Party right now is to say, no, that's not going to happen. But we've seen it happen before.
Heidi, I want to talk about the generational shift here. A guy named Richard Haas has a new book out. I think you got the first copy of the book. Haas said, shut up and read it. The book's right behind you, no doubt. You got the copy. And what Richard Haas is talking about is a social construct of the nation and our need to return to foundational civics. Okay, great. We're in the process of a generational shift in our politics, in our economics, dare I say, in our banking as well. Are we ready for the generational shift?
I think we're planting the seeds for that generational shift. I would look at one of the greatest things we've done for enabling a generational shift is really what the president is going to be touching on in his speech later today, which is a generational investment in our own economy and our future, in R&D, in advanced manufacturing, in setting the groundwork for really the next great wave of innovation coming out of the U.S. So I think that is certainly one of the bigger stories today and for the next year. What we're doing in our investment in our country.
Heidi, do you think we're doing it in sufficient size? China was very brazen about the Made in China program they unveiled many years ago. It ended up getting a lot of criticism, perhaps unexpectedly so. They were that brazen. And Heidi, I wonder, from the plans you've seen so far over the last couple of years, from this administration and the former one as well, are they being bold enough here in the United States to counter what China is trying to achieve?
So, I mean, I think it's hard to underscore just how important not just the 52 billion going into chips, but the 280 billion going into the R&D, the 370 billion going into Inflation Reduction Act, and this is meant to be catalytic capital. That catalytic capital is a huge opportunity. It's meant to bring in private sector funds. It's meant to bring in investment across the spectrum, from startups to helping reshore our technology in the U.S. So I think I think we are doing enough if we use those catalytic funds to really take advantage of capital markets, which are, in addition to innovation, we have deep capital markets that can play into this massive wave of federal funding in a way that's beneficial.
Heidi, this was super smart, and I hope we get to do it again very soon. Heidi Krieber-Rediker there of the Council on Foreign Relations, Tom. And I think the lead point there, just the merging of the NEC and the NSC and some of their priorities with China at the epicenter of it. It's pretty fascinating to see how Vice Chair Rayner is going to transition from focusing on monetary policy to going back to looking at balloons being shot out of the sky and what to do about it.
Really well said, and what it speaks to is a generational shift in these institutions. Krieber-Rediker is pro at that. She's like totally wired into the beltway structures, the pros, the cons of it. And what she said there about Brainerd knowing everybody in the room, I think is just absolutely critical.
So true. Critical. A big leadership role for Vice Chair Brainerd.
A different leadership role than what Gene Sperling had a long time ago. I'd let Mr. Sperling speak for himself. But there's something new going on here, as you mentioned, the merging and the dovetailing of this.
Equity futures right now up 1/3% on the S&P. Inflation data in America about an hour away, with yields coming in a single basis point, 368.64. Coming up next, Sonal Desai of Franklin Templeton.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
And 22 seconds away from the inflation report in America. Thanks for that. Going to keep counting for you.
What will you look for when the report comes out?
I will look for month-over-month core initially, and then we'll work from there and look at super core. Is that helpful?
Yeah, that's...
Mike McKee's going to guide us through it in just a moment.
Is like a super official number? Or is...
It's becoming one.
It's becoming
It's like, then there's Powell's number, very specific stuff. Depends what you want to call it. Equity futures look like this on the S&P. I'll do my best. Mike will as well. And so will Lisa. It's a team effort, Tom. It's a beautiful thing. Futures up 1/4%. Happy Valentine's Day.
Oh, my God.
On the NASDAQ.
You're scaring me.
So, is this too nice?
Yeah,
Let's get straight to it. Switch up the board and get to the bond market now. 2 year, 449.26. We're coming a couple of basis points. 2 year yesterday, I've said this a few times, 455, a new high of the year. I have to say, we have had a move of about 40 basis points off the lows of 2 Fridays ago. This equity market hasn't budged too much off the back of that move. We were down about 1% and change on the S&P last week and then took it all back in yesterday's session and some. If you switch up the board and finish on euro dollar, we'll get to the currency market, Tom. Euro dollar looks like this, 107.60, that currency pair positive, 1/3%. Just a touch of dollar weakness out there as yields retreat going into that inflation print. Would you like some estimates, Tom?
Please, I'm on the edge of my seat. Yeah.
Month-over-month core, which the Wall Street economists like to predict, forecast, that obsess over, and they go even deeper than that. So we'll start there. Take out food, strip out energy, 0.4% is the estimate. The previous month was a revised positive 0.4. That's all your good month-on-month stuff. The headline that you probably see in the newspaper, that's going to be headline year over year, and we're looking for headline year over year at 6.2%, down from 6.5 TK. They're the estimates so far.
It frames it out nicely here, and we'll get to the CPI here in an hour as well. I've got equity there. I guess we crack open a Coca-Cola and listen.
Oh, nice transition. Yeah, right. I like that.
When was the last time you had a
Coca-Cola? I could not tell you.
I would guess.
I couldn't tell you.
5 years.
5 years?
Yeah, that much.
It's been that long? I think it's probably in the years. It's definitely in the years.
We weren't allowed as children really to have it. It was like
no, we weren't either.
Like a luxury.
It was bottled water. Because my dad was Italian, so he did not drink tap water. That was just a thing, even if
did you have the orange Italian orange thing?
Which was that?
Pellegrino or Orangina? Orangina, yes.
We used to have...
The rich kids had Orangina.
The treat was iced tea when we went to Italy. You know, peach iced tea. Do you have that? That's a good one.
My father used to get a 2-liter bottle of Coca-Cola and pretzels anytime anyone was sick, and then he proceeded to
and he'd have it.
So that was for him. That was his medicine.
He'd be very excited. He'd be like, you need to really drink a lot. So he'd sit there and do that. All right, let's talk about Coca-Cola.
It's really speaking to our childhoods, this is. Okay, carry on.
Let's talk about Coca-Cola. Happy Valentine's Day, Dad. Coca-Cola reported fourth quarter organic revenue that actually beat expectations. Also, really in line on the upper edge of the forecast what they're expecting. It's up about 0.8%. But again, it speaks to consumer spending. It speaks to the ability to outperform. And perhaps it speaks to this ability of continuing to look past some of the potential weakness, crossing a low bar, and getting some enthusiasm in equity markets. Marriott's particularly interesting to me because we have seen the consumer spend, which we'll see in CPI, in terms of services, continue to be very strong. With Marriott, business travelers are returning, and we hear this from everyone. People are getting back on planes, and they're going to visit clients, and Marriott is benefiting because they pay a higher rate when they get some of their hotel rooms. Shopify, also interesting to me. It's up about 40% so far this year, up 1.6% in pre-market trading. They were among the first that cut workers.
Yeah,
and
layoffs.
now people are expecting them to benefit the most, John, from those cuts. This is really where the rubber meets the road. Have tech giants cut enough to really become a sort of justifiable size? Are they basically getting the tailwind from some of those cost cuts?
And will it show up in claims? So we get claims a little bit later this week on Thursday morning. Initial jobless claims, we're looking for a number of 200,000, up from 196. Now, granted, if we get that number, that would be the second week where claims have started to lift. But TK, claims at 200,000 historically is just ridiculous.
It's still ridiculous.
That's not even population adjusted. 200,000 is just a bonkers low number.
Yeah, and McKee told me years ago, pay attention to jolts to overlay on top of claims, and we'll do that as well. But what we're not talking about is retail sales tomorrow. Some people are waiting more than what we're going to see here in 55 minutes, 42 seconds.
You guys are really on a roll.
The clock, it's a great thing.
You know, I don't know what to make of that. To me, CPI is still ascendant, but nevertheless, retail sales. And retail sales, like Coke revenue, is nominal. McKee again has told me that. I don't know any of this.
Lisa mentioned this yesterday. Torsten Slock of Apollo did over the weekend as well. We get some credit card data from various firms. You get some card spending data from Bank of America as well. Mike Gapin put out the research. Total card spending per household of 5.1% year over year in January. That's why they forecast a 2.6 month-over-month spike in core control retail sales over at Bank of America. And as you know, Tom, that number, core control, that's an important input into GDP.
Well, let's do this. Let's bring in Mike McKee. We're going to speak to him here in the 8 o'clock hour, but we're going to speak to him now here 1 hour ahead. Frame this. There is a media frenzy over what we're going to see in 54 minutes, 49 seconds. I don't buy it for a minute. For guys like you, is it just another report?
It's a little more than just another report, given the situation we're in here with the Fed. But unfortunately, or fortunately, depending on how you look at it, there's going to be some oddities in this number. And so it becomes a little bit less important in the sense that the Fed, because of the seasonal adjustments and the weighting adjustments and the fact that energy prices rose some, will be looking beyond this report more than they do in a normal situation like this, where it could be critical. They also have another CPI coming out before their next meeting. So yes, it's going to be very interesting, but I think the markets have already priced for it for the most part, unless we get some huge surprise. And the Fed is going to be waiting for additional data. So it makes a great story for us, but I'm not sure it makes a big long-term difference.
We're going to catch up with Sonal Desai, Franklin Templeton in just a moment. I wanted to squeeze in one more question. I talked about headline year over year, talked about core month over month. Do you think this market responds to what you've been talking about for a while now, where you strip it all out? What's it called? Supercore, the power core? What is it?
It's kind of become the word supercore.
What is it?
It's service. It's core services. Take out energy and food, and then take out housing services, and you're left with basically most of what people spend money on. And because housing is so uniquely calculated in the CPI, it's a distortion to what the inflation rate is. So you take everything else out and you see what's happening with services, and most of that is driven by wages. So the Fed is keeping an eye on what's happening with wages and whether that's pushing up inflation. And that's the measure they can find that will tell them that.
Okay, because people go nuts about this, and you know that. It's like stripping out all the stuff we need.
No,
energy,
we're
food, and shelter.
No, but
they just strip it all out.
You bring it up. This is really important, folks. This is the heritage of Bloomberg surveillance. We're going to do this without hysteria.
Sure,
it's a big deal report. Everybody's waiting for it. If you're not part of the market, folks, trust me, it's Inflation Tuesday.
Inflation Tuesday.
It's Inflation
Has that replaced Payrolls Friday?
No, it hasn't, but it's amazing how many. Tomorrow's Retail Sales Wednesday. Roses go on sale.
They do.
They do.
That's when you buy
Folks,
them.
this is very
CPI
important. I
goes
know,
down.
Amy,
Yeah, exactly.
you're prepared for
That's
this.
right.
Tomorrow, roses on sale, February 15th. Look for that. There's your Bloomberg reporting for this morning.
How's everything going at home?
Oh, things. Oh, it was good. What's great about it was you have the martini, you just throw the olive. You know, it's just great.
You throw olives in the
You
house.
throw olives in the house. Vet Bill's going around eating them as we go. Right now, we're going to go to someone. This is really well done here. Franklin Templeton. Thank you so much, Amy, for making this work. Sunil Desai is the Chief Investment Officer of Franklin Templeton Fixed Income. And this harkens back to the moment you're living now where everybody's got international on the brain. And a guy from Tennessee out in the Bahamas and up in Toronto long ago and far away with the Templeton Growth Fund and then the Templeton World Fund. Chanel, thank you so much for joining us this morning. Quickly here, is 2023 a year that Sir John would enjoy? Is it a year for international value?
I think probably, and I'm not going to commit too much in terms of equity here because, as you know, I'm not the right person to talk about equity with any great expertise. But I would actually have thought that last year would have been his kind of year. Absolutely.
You know, one thing that I'm struck by is financial conditions easing to early 2022. And this is something that Torsten Slok over at Apollo pointed out this morning as well. What do you make of this at a time when you do see banks tightening some of their lending conditions, where rates are so much higher? It's counterintuitive. Can you frame out how problematic this is for the Fed?
I think it is problematic, and actually, this is something after Chair Powell's last press conference, I noted in something that I wrote. He did not address what I thought was the elephant in the room, which was financial conditions. We had already unwound close to 425 basis points of Fed rate hikes. Powell continued to say that financial conditions had tightened. They had tightened only in comparison to where they were in the extremely easy period post-COVID. Well, we're not in the post-COVID period, so I think it is pretty problematic. Mortgage rates are off their highs. I would say that we've seen the type of rally in the first month of the year, 8 to 10%, in equities, close to the same thing in fixed income. It's very easy, and the dollar has depreciated. Everything added up together, it's a problem for the Fed.
So now, can we just wrap things up
confidence should follow
on this
right?
one? Because you were so good last year on saying there's upside risk to the Fed's hiking cycle. You were so good the year before talking about inflation not being transitory. You thought it would be sticky. So now I just wonder, based on market pricing, alongside Fed projections, do you still see there to be upside risk, significant upside risk to the terminal rate?
So not significant, no. I'd say that we're probably at least going to go to 525, 550 and then pause. I'm glad to see the market has come back towards thinking about at least 525. I think then the Fed will pause. What I think there might still be upside risk to is year-end inflation expectations, where the market, pieces of the market are already coming back to somewhere between 2 and 3. And again, it's nuanced, right? I think that at the end of this year, we will still be closer to 4 than to 2, and that's going to probably be unacceptably high. So I think we need to really price out those rate cuts fully from the second half of this year, and those need to remain priced out.
So now, thanks for jumping on the phone for us. And again, fantastic year ahead series in Barron's over the last couple of months. Really enjoyed that. Sunil Desai there of Franklin Templeton. TK, she's been right the last couple of years. Upside risk to inflation, to the terminal rate, the Fed, and now maybe that stickiness in inflation into year end is going to push out some of those rate cut calls in this market.
You see it in tea leaves across the curve, John, and right now, and this to me is truly historic, coming off the pandemic, and frankly, getting back to where we were in 2006, a 6-month T-bill off to Bloomberg, it's a printed 5.013%. Wow. That is the statistic of the morning.
How much time on the clock? What's left?
48 minutes, 10 seconds.
Nice.
Oh my gosh.
Inflation data just around the corner.
Inflation Central.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Police say a gunman killed 3 people and injured 5 others at Michigan State University's campus in East Lansing Monday night. The suspect was later found dead after apparently taking his own life. Police say the 43-year-old shooter was not affiliated with MSU. That investigation is ongoing. The U.S. Environmental Protection Agency says Norfolk Southern may be liable for cleanup costs related to the derailment of a train carrying hazardous material. The derailment started a massive fire in Ohio earlier this month. A Norfolk Southern spokesperson says that it will continue to perform or finance environmental monitoring and remediation. Bloomberg has learned that a former Credit Suisse employee copied and took personal data from other staff members, including details of their compensation and bank account information. The company warned of the breach, which took place some years ago, in a letter to employees. The staff member had legitimate access to the data at the time and transferred it onto a personal device in breach of Credit Suisse policies. The supplier of batteries to Volkswagen and BMW could reap billions from President Biden's electric vehicle bill. Northvolt joined a chorus of European companies putting policymakers on notice about the allure of U.S. green tech incentives in Biden's Inflation Reduction Act. The tax credits included in the law cover about 30% of cell manufacturers' operating costs. If the Swedish startup built a similar-sized factory in North America, it would save about $8 billion in tax credits by the end of the decade. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
And says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
The fact that the consumer has so much still accumulated savings, now these savings are coming down, but I think that's actually widened that lag period for the consumer to actually start to cut back on spending. And I think they are starting to cut back, but the labor market is strong and I still have accumulated savings. When those savings run out, in our view, that happens in the second half of the year, that's when the consumer starts to cut back.
Priya Misra, Global Head of Race Strategy at TD Securities. Honestly, TK. Why did you ask that?
Because we're going to do a car thing here, and I've never known how to pronounce.
I've got no idea if the mic was hot or not. Anyway, futures on the S&P. We'll get to that, whatever that was. Just a moment, just in case you missed it or you heard it. I don't know. Up 1/4% on the S&P. Yields come in a basis point on a 10-year, 368.45. For those of you interested, Supercore. Mike McKee left the building, but he gave us this little piece of information. If you have a Bloomberg terminal, I know many of you listening do. So the ticker for Supercore, so this is CPI Core Services less housing month on month, is CSXHPCM Index. If you want that again, it's CSXHPCM Index on a Bloomberg terminal, Tom. Is that helpful? Helpful for me anyway, because a lot of people are going to go through this report and they'll probably want that number instantly, and we'll do our best to get that out for
and
you.
tomorrow we'll have retail control group, which is sort of the same idea.
The input into GDP, yeah. Which Mike Apron's looking for a punchy number off the back of a decent credit card spend in January.
Can I just say, this is all just new ways of stripping out the disposable income that people have, right? Basically, how much disposable income do people have and are they spending?
Yes.
So this is just the cleaner way to say it's a way to strip out all of the base costs. How much do people have left over and how much are they willing to put out there?
I wonder what percentage of Americans think this is absolute baloney.
They think it's nuts.
Nuts. It's nuts.
Overwhelmingly so. I mean, I said that a couple of minutes ago. We're stripping out all the stuff that people are highly dependent on. Food, energy, and shelter. It's insanity.
Today it is as well. 41 minutes, 52 seconds away from all this. Thank you for joining us. We're going to digress. We're going to digress to the emotion that someday you too could have a Ford or a Chevrolet. And I was interrupting John as he was going to air there. John, is it a Vauxhall?
We used to have a Vauxhall, yeah.
Vauxhall?
Not me personally. We had a Rover. We had a Rover 416. That's what we have.
It's a cultural thing, folks, and David Welch and Keith Naughton kill this for Bloomberg here, that guess what? New cars, and dare I say even some used cars, are only for the rich. Joining us now, Craig Tudell on the inflation in core cost automobiles. What percentage of Americans, Craig, can afford, for that matter worldwide, can afford a new car?
Well, they're awfully out of reach for more and more Americans. I know my old Oldsmobile that I started out with now, is not, obviously they're not around at all. But, the existence of an affordable new vehicle, it's really, really sparse. Even on the used side, we're in a situation where the amount of supply out there, because of the crazy circumstances of the last couple of years of the pandemic, where the car was the ultimate social distancing device, right? And so we saw a lot of sopping up of used car supply, and on the new side, obviously we haven't been able to replenish dealer lots because of the fact that the manufacturers have had the chip shortage to deal with, and that's really continued to hamper them on the production side. Even when they're able to produce more, they're at least saying that they won't go back to their old ways of overproducing, putting a bunch of incentives on those cars, and selling them at losses or really thin margins.
Craig, increasingly many manufacturers introducing EVs. Craig, can you tell me how that started to influence the number, if at all?
Yeah, absolutely. I think, just sort of very simply, it's still much more costly to build an electric vehicle with a battery powertrain than a combustion engine powertrain. And obviously, this is moving. I think the expectation is that there will be a sort of crossover in the next few years, depending on the segment. And there are a lot of ways to sort of slice and dice that data. But for the time being, it's still much more expensive for manufacturers to make electric vehicles than combustion vehicles. And we're in a situation where, we talk about supply-demand dynamics being very sort of off balance for the market in general. In electric vehicles, it's even more extreme, where you have, some people waiting months, even more than a year, for their EV that they want to buy. They can't take delivery because manufacturers are having trouble keeping up with that demand.
How do you think the proliferation of EVs, Greg, will change the used car market? I just wonder, some of those cars without warranties, the replacement cost for some of those batteries is ridiculously expensive. What do you think this could mean for the used car market?
It's a really fascinating question. There are a lot of puts and takes there. I think Corey Cantor at Bloomberg Neff has done some really interesting work on this recently. Folks who are subscribed to Bloomberg Neff and on the terminal ought to look up a recent report that he's done on this. I think, in broad strokes, there were a lot of concerns in the early days of EVs about residual values and whether EVs would hold their value because of those concerns about how costly it is to replace a battery. You saw also just a lot of lease deals, right, where these were sort of compliance cars that weren't particularly attractive, didn't have a lot of range, and so there wasn't a whole lot of demand for them. You saw manufacturers, put highly incentivized lease deals on these just to move the metal, and that, just obliterated their resale value. We're now in a situation where there's still a lot of question about how much these are able to hold their value. I do think that, the sort of naysayers who dispute whether or not EVs will ever, hold up as well as combustion cars. You look at what Toyota has done with the Prius, or what Tesla has done with some of its EVs. I think, maybe with the exception of just recently when they slashed new car prices, before that, they really had strong resale values, and that was, really standing out when you crunched the numbers and took a look at how EV residuals were trending.
There's another aspect to the higher prices, and that is by strategy. A lot of auto manufacturers are producing less, being more selective about which cars they put out there, putting more expensive models out there. At what point will this become a political issue where suddenly you'll get this sort of pushback? Guys, make some more cars for the common American, the common individual across the world, rather than just sticking with the high margin products.
That's a great question, and I particularly hear it more over here in Europe, and I think I would attribute that to the fact that there's real concern about, sort of creeping relevance of Chinese manufacturers. You're seeing more and more Chinese automakers start to export, more of them taking a look at Europe, and real concern on the part of executives of, look, Carlos Tavares at Stellantis, the owner of Jeep and Ram, he's talked about the idea either we need to bring the cost structure of European manufacturers down to be competitive with China, or we need to, take a good hard look at whether or not we need to put up trade barriers. And so it's all sort of very reminiscent of, decades ago when we were talking about, the Japanese and then Korean manufacturers, looking abroad and looking at markets in Europe and the US, real concerns about, cost structures in China, leading to, say, a Mini built here in the UK not being competitive with one built in China.
Here we go again, it seems. Greg, thank you. As always, Greg Trudell there. Certainly, Tom, some of these Chinese manufacturers, some of these local brands are becoming more and more popular on the mainland. The huge effort we've seen from some of the more established brands out of Europe and the United States to make inroads into China. I just wonder how much they're going to be crowded out in the years to come.
It's been there forever. It's like a conversation from 50 years ago in Japan. To me, it's just manufacturing. It's a labor arbitrage, a phrase I'm stealing from Stephen Roach. And what's interesting here is not so much China-Europe, which I totally don't get, but China manufacturing to Japan or other places on the
sort of
Rim.
Perverse irony of this all, though, is that right now, the reason why Germany may not turn against China is because they depend so much on selling their cars to China. If they become less competitive with respect to selling their autos in China, does that actually increase some of the tensions where you start to just get outright bans?
Can I make this granular?
Sure.
I mean, I don't even look at the car names. All I know is a $47,000 Kevin Bacon.
I saw that.
Okay,
Talking about the commercial in the
Super Bowl. I think with his daughter, the great actor Kevin Bacon. What it comes down to is $931, 35 months on the grid, something like that, auto payment for 4 years, which is $11,200 per year you have to pay to buy a Kevin Bacon. And, take the other cars as well. How much of America can afford a Kevin Bacon?
My frustration with the way the EVs have been rolled out, are we seriously saying a Hummer is good for the environment just because it's electric? Is that seriously what we're going to say?
I've never bought it.
It's
Where do you get them charged in Manhattan? Seriously.
There are charging stations. There are charging stations.
There are.
You're asking me. I don't have an EV, but
They're down off Chelsea Pier. Everybody's got to drive to Chelsea Pier to charge up.
The charging isn't the issue, not in major urban centres. I think the issue is just how environmentally friendly they actually are. Yeah. Like some of these are massive. They're huge.
Incoming hate mail.
CPI data up next.
So the inflation environment has been changing a little bit. Inflation's been very low for 25 years. Now people think inflation's coming back. How are you going to deal with that?
I think many of the tools that we've historically used to battle inflation no longer work in the same ways they used to. I think people oftentimes thought of housing as a way, or especially retail and real estate as a way to hedge against inflation. Less and less possible the way we've invested in it. I think commodities similarly have been thought of as a way to hedge against inflation. There are challenges over the long term. Equities have been a hedge against inflation. We will continue to do what we have done in the past, which is build a diversified portfolio where there are many different opportunities that have the possibility of hedging against inflation, because different types of inflation have to be hedged in different ways. So if it's a very quick increase of inflation as opposed to a slow rise of inflation, is it temporary? Is it a long or persistent type of inflation? So for us, I never model myself an economist that can predict where inflation is going. And so what I need to do is build a diversified portfolio where there are different options that can fight the different types of inflation and to pay close attention to it. And you know, fundamentally, it's done through the equity markets.
So you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, you know, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
The top names in business are on Bloomberg.
I think the future of autonomy is real for civil. It's going to take time. Everyone's got to build confidence. We need a certification process that we all have faith and believe in. As you may know, we have an application on an all-electric autonomous airplane. We refer to as WISC. There's so much to learn, so much to do, but it is being done.
Nobody covers business like Bloomberg, your global business authority.
I think the January data in the US is essentially going to come in strong.
There's a possibility that inflation goes back up.
When the dust has settled, inflation may also be persistently higher than what we had before the pandemic.
If core services ex shelter remains strong, which is our view, the Fed is not stopping yet.
We have the Federal Reserve doing the job to end the period of free money and put us back on a more realistic course.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. A most important Valentine's Day, outshone by inflation here in 29 minutes, 16 seconds. We are steeled for it. And, John, so was the equity market voting yesterday afternoon, and the vote continues this morning. Futures lift up 14.
There was a vote in the bond market as well, 455 on a two-year. Yields elevated over the last couple of weeks, pushing higher going into CPI. Then on to retail sales tomorrow. So we're looking for CPI to come in without the deceleration month on month that people are hoping for. That's the estimate so far. Then on to retail sales and people looking for a punchy number there as well. Overwhelmingly, what changed the story for so many people was that blowout payrolls report. And a lot of people then started to push out their recession calls, bring back in the prospect of getting to 5% at the Fed. And we'll see if the inflation data and the data in the coming weeks changes that.
The Global Wall Street, stay with us for this hour. Kenneth Rogoff will join us. We're thrilled to bring you Stephen Stanley, just magical on the granular data with Santander. But John, to me, the conversation of the morning, and I wonder where are we in 1 day, 2 days, 3 days, was Anahan of Wells Fargo as Wells Fargo shifts their equity call.
They say it's no longer a bear market.
There it is.
And then Bank of America, they put out their fund manager survey a little bit earlier this morning, and expectations of recession have gone from like 77% probability, and they've been crushed. What are we now, Lisa? Where are we? The 20s, the 30s, just in terms of the probability in that report? Find that absolutely amazing. They point to the prior peaks of April 2020 and March 2009 and say typically when that recession fear peaks, after that you get the start of a bull market. The pushback you'll get, though, to that report is that we haven't actually had a recession yet in America.
And the other pushback is, what kind of bull market is this going to be? I mean, even Anahan, yeah, maybe they're changing their forecast, but it's a bull market stuck in traffic, or maybe it's no, animal at all, because basically what you're looking at is a muddle through. I mean, our year-end forecast is 4,200. It's not exactly a screaming bull market that's going to cause some sort of incredible gains.
It's about the journey, not the destination.
Oh, jeez.
Is that your Valentine's card for today?
That's what I wrote in the card this morning. It's about the journey, not the destination. CPI's at 8:30, don't forget.
It's a sensitive Pharaoh with us today. We're going to get through this, folks, and try to last through 10 a.m., which we're all going to go have a wonderful Valentine's Day breakfast.
And then watch Milan versus Spurs a little bit later.
Spurs, very important
Nice.
after the surveillance. Nab, Lisa, there is an historic moment today. I mentioned this in the last hour. To me, it's without question the tea leaf of this morning. 6-month T-bill prints of 5.01%. You led on this 10 days ago with T-bills in general coming up. Forget about the 2-year. Further inside that, in the land of Ira Jersey, what's that signal?
Well, bonds and stocks are voting for different things, right? I mean, on one hand, bonds are preparing for a much higher rate future, and they are bringing forward their forecasts for how high the Fed can raise rates. So when does this start to have a material effect on valuations? If suddenly there is an alternative, cash looks great, you're getting paid to wait, we keep hearing that. At what point does that fundamentally shift the risk-reward proposition for equities in a way that hasn't yet been felt?
John, my data point for this morning is we're 26 minutes, 8 seconds away from a key inflation report. What else should we look at?
We'll look at equity futures and just whip through the market action just briefly, up 1/3 of 1%. Yields in a couple of basis points on a 10-year, 368. And in your FX market, bit of dollar weakness here, Tom. Euro dollar 107.65.
This is well timed. He is wonderful because he can go across assets. David Balin's with his Chief Investment Officer, Global Head of Investments at Citi Global Wealth. David, how close are you to amending or tweaking your 2023 outlook?
Not very close, Tom. At this point, we just haven't seen earnings decline. Enough evidence of that. We've already seen earnings become disappointing. And I think that markets ahead of us are actually optimistic that somehow we're going to avoid a real slowdown in the United States, and that seems highly unlikely to us.
David, let's talk about this CPI data and what it could mean for higher terminal rates. A lot of people think there's upside risk. Some of, as I said, perhaps we get to 5.50 and then stay there. How do you frame that conversation for your clients?
Well, first of all, everyone's very fixated on the month-to-month change, and they're looking at everything, with great urgency right now. And this month, we could see a surprise on the upside because you have higher energy prices, that are, imminent with this last month. So what I think you have to do is you have to think about what the trend is. And the trend on inflation is clearly downward. And if we look month to month, that's one thing. But if you were to look over the course of the year, we could imagine inflation running at a 3.5% to 4% rate by the end of the year, and certainly, into the 3% range by 2024. And that's the trend that's upon us. And if that's upon us, then obviously that's a good thing for the economy. Right now, what the bond market is doing is the opposite. It's sort of saying, hey, rates are going to stay higher for longer. And that assumes that there is simply no slowdown in the economy right now. And as I mentioned earlier, that's unlikely to us.
So in other words, you think that the divergence between bonds and stocks errs more on the side of stocks being right and bonds being wrong. Is that what you're saying?
Well, what we're saying at this point is that stocks are optimistic. They're looking through an earnings trough, and they don't understand that it could be substantial. We're predicting that earnings in the U.S. could go down by 10%, right? And we're already on the way there. We already see disappointing prints in many industries over the course of the last several weeks. So if that's the case, I think stocks do have a leg downward. Take a look at the short position in the market right now relative to where it was in 2008 and 2009. We had a huge short position then, and we have an even bigger one now. So a lot of these rallies get carried ahead by that short covering activity.
So right now, what do you think the fragility is of this market to whatever the print is that we get in about 30 minutes time, 24 minutes?
Well, I think that the market, you take a look at the movements that have taken place in the 10-year. You've been at 440, you've been down as low as 350. All of those changes are happening within, just a month or two. And that to me tells you just how volatile the market is. But to your point earlier, one of these markets is going to be right. And we do think that it is the bond market. And if you take a look at its ability to predict recessions, with 90% accuracy, when you have the, an inverted yield curve as strong as the one that we've seen, it is very hard to ignore that. So I guess the answer, Lisa, is that we expect the bond market ultimately to be right.
Hey, David, I don't want you to comment on an individual stock. For this morning, it's Coca-Cola. But the bottom line is it's organic revenue growth to dream of. Let's call that a nominal GDP proxy. And free cash flow just isn't there. And granted, it's a lift in the market, but that's the dovetail. Sustained organic revenue growth versus margin challenges. When you dovetail your security analysts into all your work, what do you say about those two conflicting forces? Great revenue and margins that aren't all that great.
Well, you would imagine in a market like this, Tom, exactly that problem for most companies, right? Their ability to maintain pricing power, which they had during the pandemic, was absolutely clear. And now that's fading. Their ability to actually raise prices to maintain margins is actually fading. And that's happening in many of the consumer industries, any place where there's a lot of inventory. And remember, we do expect actually that, retail sales can go up and down by the weather as well. And this was obviously a better month for weather. But the truth is that the amount of actual consumer spending is heading down in real terms. And with that, margins will head down. And I think that's another example of why earnings on a forward basis, certainly for the next 3 to 6 months, are actually on a downward trajectory.
So, David, if that's the case, where's the haven right now within the equity market? Where do you find safety?
Well, safety is a very important thing, and the way to find that is in stocks that really don't have that problem. Let's just take the pharmaceutical industry, where you have a combination of high and growing cash flow, you have the ability to maintain margins, and you have high dividends. And that may bore people, right, for the moment, because there's so many of the stocks that have done well this year are the real laggards that have done, did very, very poorly for the last 3 months of 2022. Those stocks that are tried and true beat the market last year. I think they'll beat the market this year. And at the end of the day, the only time that we want to be, heavily invested in some of the, higher beta parts of the market is when we see that we're at the trough of those earnings and we're looking into 2024 and our expectations are materially higher. We just haven't gotten there yet, and people are very impatient.
David, a lot of people are coming on programs like this and saying, buy T-bills. Could you just go a little bit deeper than that and tell us whether it's a little bit more effective to buy, say, an old 2-year with a 12-month maturity left on it? Can you just run us through that? What works best?
So the first thing and the most important thing to tell everyone is that they should be investing their cash, because lots of clients have way too much cash, and whether it's a 6-month or a 2-year or whatever, that's what they've got to do. But there are so many opportunities now to lock in yields from 2 years to 10 years, investment grade credit, preferred stocks. Lots of the, bond market is really, really rich. And I don't think we're going to be at these rates when we're here, just a year and a half from now. So the critical thing is to realize that bonds are back, that the idea is that we want to have a full allocation to them, and we don't have to take a whole lot of credit risk. So if I were advising a family today, it would be, to be out on the 5 or 10 year range, because you can always trade that in. You can always trade that in for other bonds or for equities, but you can't get these yields a year from now.
David Balin of Citi Global Wealth. There are various tax-efficient ways of doing that, but ultimately that's the conversation. That is FOMO, yes, Tom?
That is bond FOMO.
The fear of missing out,
yeah.
Sure.
I know, it's fascinating. It's amazing just how we get jaded here, folks, because we're grinding this out every day. Where were we a year ago?
Well, to your point, Tom, on the FOMO, I think the point that David's trying to make is if you took, say, let's say you take a 12-month T-bill right now, or even 6-month, what David's saying is that he doesn't think these yields are going to be around for long. So 12 months from now, you won't have the opportunity to take 5% again. He's making the point you go further out on the curve. And that just depends, Lisa, on whether you think this is real regime change or not, whether you think we're going back to the days of 2019, pre-pandemic, or things are going to change.
That's the reason why people say on the short term, it seems like a clear buy. People are just basically giving you a victory lap, Tom, with respect to triple leveraged all cash. But at the same time, they're saying longer term, we don't know, right? Because we don't know what the new regime is. We don't know what kind of real yields there will be, as well as where the inflation rate will end up. That is the vague aspect. And then you have the likes of Christian Olting, who came on earlier and said he sees 420 on a 10-year. So that would actually be quite a bit of pain, at least from here to there, if someone went into the longer duration.
What's on the clock? 18 minutes and 36 seconds.
Yeah, 6 months just printed up to a 5.02. I got an announcement. We've been really dealing with.
Oh, here we go. Drum roll. What have you got?
Drum roll. Well, we've been trying to reposition triple leveraged all cash, and we got the triple leveraged all cash GPT ETF.
Nice.
It's in registration right now.
Nice. That'll get the inflows, TK.
We're looking at it.
No, I don't get it.
It's got a what's a GPT with a cash?
You just put GPT on everything.
All I said was, look, I got to make 2 and 20.
/AI.
Okay, I got to make 2 and 20. What's higher? They said all cash GPT.
I didn't realise that Stephen Stanley's gone to Santander.
Yes.
Okay,
yes,
nice.
Yeah.
Nice. We'll do that in about 18 minutes. Looking forward to that. Inflation data, 17 minutes, 55 seconds away. Futures up. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Ukrainian President Volodymyr Zelensky's embattled defense chief appointed 3 deputies as part of a shakeup aimed at cooling accusations over corruption in the top echelons of the government. Defense Minister Oleksiy Reznikov is doing damage control after officials under him were swept up in a probe looking into procurement violations and skimming funds. Since then, Zelensky has signaled support for the top aide as the country braces for a possible Russian offensive. Russia's nuclear exports have surged since the invasion of Ukraine, boosting the Kremlin's revenue and cementing its influence over a new generation of global buyers. Exclusive trade data compiled by the UK's Royal United Services Institute shows that Russian nuclear fuel and technology sales abroad rose more than 20% in 2022. Purchases by European Union members climbed to the highest in 3 years, from Egypt and Iran to China and India. Turkey is throwing its full weight behind stocks before its planned stock market reopening tomorrow. Bloomberg has learned the government is channeling billions of liras from pension funds and state lenders into the stock market and planning tax waivers for buybacks. That's part of a plan to contain the market fallout from the February 6th earthquakes that hit the country's southeast, killing more than 37,000 people in Turkey and Syria. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power. This is Bloomberg. Innovation strikes. Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg. Wall Street prepares for the latest read on inflation.
There's a huge amount of uncertainty out there.
We're going to get some lumpy numbers. Will annual rates continue to fall?
If we get a hotter print, how much does that really take some of the momentum out?
Instant reaction on Bloomberg Surveillance.
The data have come in stronger than expected.
Or are they literally making it up as they go?
Plus an exclusive interview with Richmond Fed President Thomas Barkin.
It just makes sense to steer more deliberately.
February 14th might have something to say about that.
Inflation in focus today on Bloomberg.
It's about the labor market. The Fed is very concerned that that the price increases are going to be sustained unless we really see a step down in the growth of the labor market, and that most recent jobs report suggests anything but that.
Randy Krosner there, the former Fed governor and current University of Chicago Booth School professor of economics. That payrolls report a couple of Fridays ago just shaking up things big time for so many people. It's like you thought one thing and then the market rallied aggressively. You got that print and it's, okay, I need to restart 2023. Where are we?
100%. And then people in the equity market were like, never mind. And actually, San Francisco Fed came out with a report and they were like, actually, it was really due to the weather. There was a huge weather adjustment in terms of employment, and the people read that more closely.
Mike McKee can tell us about that in a moment. Equity futures right now up 0.25%. The inflation data is about 13 minutes away. Looking forward to that January CPI report. It's just around the corner with yields coming in a couple of basis points against the grain of the move we've seen over the last week, Tom, on a 10-year, about 368 right now. But over the previous week, a move of 20 basis points for the 2-year and the 10-year. We saw some big moves.
It's really, really exciting. There's no other way to put it. I mean, I think it's really, really interesting, the gyrations. And I'm going to go back to the equity market and the lift yesterday. I'm not even sure why we lifted. We lifted.
We did lift,
We lift. I mean, there it was.
I'm not going to try and explain every tick. I'm not sure what yesterday was about.
I think that's a really important point. That's how stupid it's gotten. People are trying to explain every tick.
And it has
it's
got
ridiculous.
stupid. I agree.
It's gotten stupid. To clear us of the stupidness of it all, Stephen Stanley joins us now, Chief U.S. Economist, Santander U.S. Capital Markets. Steve Stanley, thank you for joining us with a brief here. You and I remember the idiocy where the world would stop M1, M2, M3. I think it was Thursday afternoon, long ago and far away. How silly are we being right now here 11 minutes, 28 seconds away?
Well, I do think there's a lot of seasonal noise in the data. We saw it with the January employment report. I think we'll see it again tomorrow with the retail sales numbers and to some degree with the CPI. And you had 3 very low readings to end last year and everyone got really excited about inflation is under control. And then last Friday, we got new seasonal adjustment. They ran the seasonal adjustment program again, and they revised up October, November, and December for the core. So all of a sudden, that downward momentum on inflation has kind of dissipated. And I think we're going to see more of that today. I'm looking for a 0.4 reading on the core with maybe some upside risk to that.
Stephen, this conversation about Supercore, can you just shine a light on some of the conversations you have with clients at the moment? Are they asking about that a lot? Do they expect an estimate from you? What do you say?
Yeah, people are definitely starting to try to focus on that. I think, you know, the key here really is this housing piece. I mean, we're taking that out. It's over 40% of the core. So, you know, when you take that out, you're taking out a pretty big chunk. But the presumption is that housing expenses are going up fast right now, but they're going to come off later in the year because of the lags involved. We know that the housing market has cooled off, and so people are wanting to focus on, you know, on the other pieces in the core. But the broad point is that services prices tend to be very sticky, and they've accelerated, and I think it's just going to take quite a bit of time for them to come back off.
With all of these seasonal adjustments, Stephen, and as we watch some of the upward revisions, even on the prior month CPI that's heading into this current report, are we going to look back and say there wasn't that much disinflation at this point, that was sort of a head fake at a time when services still were reaccelerating?
Yeah, well, if you look at what happened late last year, it was just a handful of very volatile categories that were pushing things down. I mean, gasoline was the most obvious one, but used car prices were falling rapidly. Airfares were falling rapidly, which was really the same thing as gasoline prices. It was the reversal of the big spike that we saw in energy costs after the Russian invasion of Ukraine. So you could see at the time that it was not sustainable, the low core readings that we were getting, the low headline readings that we were getting. And I think now we're getting back to something more in line with where the fundamentals are.
All right, so now we're going to get a Fed parade, including Tom Barkin joining John Farrow and Michael McKee coming up here. What are they going to say if this is a hotter than expected print?
Well, the Fed has actually been leaning against the market enthusiasm and saying, hey, look, this is going to be a tough task ahead of us. It's going to take quite a bit of time. So it's not going to be I told you so, but it's going to be, I think, much more steady as she goes for the Fed than it will be for the markets. It feels like to me that the Fed has really almost locked in a game plan here. They want to get rates just above 5%, which probably means 2 more quarter-point hikes. And then they want to pause and give it a few months and see what happens. And so I think the bar is probably relatively high for a divergence from that short-term game plan on either side.
Stephen, to the breathlessness 8 minutes, 6 seconds away, is this idiocy, excuse me, I editorialize here, John, please excuse me. Sir John, I'm sorry. This idiocy, Mr. Stanley, of nowcasting. The beloved geniuses at Cleveland, who I adore for their work on inflation for 20 and 30 years, even they have dived into the value of nowcasting. Is there any statistical value to navel-gazing nowcasting?
Well, I guess we've all, as economists, we've all been doing that to a degree. I don't like to advertise my number on a day-to-day basis, but really, at the end of the day, the one price that we all can track very closely on a day-to-day basis is gasoline prices, and that is responsible for a good part of the high-frequency noise in the data. Otherwise, I think it's pretty tough. I mean, how do we know whether there's going to be an upside or downside surprise, for example, on shelter costs or recreation costs or medical care? I mean, we don't have a lot of data on that. So there's certain things that we can track and others that we can't.
You keep your nowcaster secret, Stephen. Is that what you do?
That's right. That's right. I can't show you everything.
Stephen, stay close. Stephen Stanley there of Santander. Mike McKee's our nowcaster.
Road trip.
Where to?
Stanley. The three of us.
Spain.
Seville. Spain.
I knew it.
I mean, come on. High-speed
so
rail, flying to Madrid, high-speed rail to Spain.
Free association.
The three of us, Steve Stanley, Miss
travel.
Boten could stop by.
That works great.
Miss Boten could stop by.
Yeah, I'm sure she's excited
Work
for
out
that.
great.
Happy Valentine's Day.
Let's go to Mike McKee, the Federal Reserve Bank of McKee on nowcasting. Is there any value to all this madness as we are now 6 minutes, 25 seconds away?
Yeah, not really. I suppose if some investors making an investment decision on a particular day might think so, but as kind of follow up to what Steve was saying, they teach you in economics school that you give a date or you give a number, but you don't combine the two in terms of a forecast.
But it's nowcasting revised. I mean, these revisions are serious. We have great respect for what you're doing, BLS and the rest of it. Nowcasting is like betting on the Super Bowl.
Well, it's a little bit.
The Chiefs, do they have a chance?
Yeah, it's a little bit like political polls in the sense that any political poll is a snapshot of the day that people were asked, and it doesn't tell you what they're going to think down the road. We look at the Atlanta Fed GDP now number all the time, and that's given the data that they have. Well, in January, we don't have any data, but they still put out a nowcast, so it changes a lot.
Can we have the snapshot of what you'll look for when this number drops in about 5 minutes? What will you look for immediately?
Well, immediately we'll look to see what energy prices did, because as Steve said, that was probably something that did drive things up, and then housing prices. But we'll look for that super core and see what's happening there, because that's the thing that's the most important to the Fed. A lot of other categories will go up and down, and we'll see what contributed to it. But overall, let's see what the Fed wants to see. Let's see what that tells us.
Lisa wants Supercore straight away. First number. Where is it?
I can't take it seriously.
Do you think the goalposts have moved? Do you remember, Lisa, when Chairman Powell said there's no space for nuance? And now all of a sudden there's space for nuance?
It's now slicing and dicing to such a degree. You strip out housing, you strip out everything but services, you strip out energy, you strip out
We did that
food.
when everyone said it was transitory.
And now
it was
people
just
are
like, cut this out.
Looking at this. And the bottom line is, inflation has come down, but it hasn't come down that much. And I think that that's the takeaway. So now the issue is, does the Fed have to be more aggressive in their pushback?
I'm looking at year-over-year log supercore, and it really tells a story here. I'm sorry, from 0.9% to 6.43%. There's some real, it's dramatic.
Equity futures right now up 1/3 on the S&P. Your inflation report is 4 minutes and about 13 seconds away. With futures up and yields in down 2 basis points. CPI data coming up next.
what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
News breaks. No one covers the world like Bloomberg.
Return to pragmatism is really that everybody's in line. The government, the enterprises, the people, in pushing this economy. It's like a cycle of renewal.
Big tech layoffs rolling in. Spotify, the latest to tighten its belt, with plans to cut 6% of its employees.
Is the economy unfolding as you thought it would?
I think the economy is responding to work that the Federal Reserve is doing.
Bloomberg, your global business authority.
Inflation data in America just around the corner, seconds away. Going into it, equity futures are positive by 1/3% on the S&P. Mike McKee seated and ready to go to break this number down for you. Yields come in 3 basis points going into the print on a 10-year right now, 367.12. I can tell you on a 2-year, down about 2 basis points as well. Sub 450, we're at 449. With your CPI data, here's Mike McKee.
Well, we're waiting for the CPI data to drop. And of course, by computer, it just comes in right now. And it looks like we are pretty much bang on as expected. A 0.5 gain for the headline number after a 1/10 gain in the month of December. Of course, that was revised last week. The core comes in at 0.4. That was expected, and same as the December number. So that puts us year over year on a headline basis at 6.4%, which is higher than the 6.2 that had been expected, and 5.6 for the core on a year-over-year basis, higher than forecast as well. But both of those down a tick from the December numbers. So we are seeing a little bit of improvement, not as much as perhaps people would have liked, but basically we are seeing there are some statistical changes that may have affected this. So we'll go through the numbers and see what the actual changes are. The one thing I can tell you, because you asked me, John, was gasoline was up 2.4% in the month of January. And so energy prices there did make a difference. Natural gas prices were up 6.7%. That had been a weaker area, but, you know, with the cold weather, come up a bit.
Mike, you keep breaking this down. I'll just break down the price action. We were positive. We're now slightly negative by not even 1/10 of 1% on the S&P 500. Yields were lower on the session, then they flipped positive. So they were down about 2 basis points. We're now up about 2 or 3 on a 2-year to 454 again. 455 was the high of the session yesterday. So we're kind of back to those levels again. Up about 2 or 3 basis points through the front end of the curve into the belly onto the 10-year, up about a single basis point to 372-ish. These aren't major moves relative to where we have been. But Lisa, the data is something we'll continue to chew over in the coming hours and the coming days, no doubt.
This is significant, especially on the heels. Yes, it was bang in line with the survey. However, the revisions that were upward for the prior month pushed the year-over-year comparison to really not declining all that much. I mean, how much does this really edify what Stephen Stanley was saying? Perhaps we're getting some disinflation, but it is much slower than people previously thought. And I think that that stickiness is what you're feeling in the core and the headline number.
TK, your take on this one?
My take is Bloomberg's got really good immediate parsing of this, and a lot of trends just continue off this. I think what we're going to hear is it's another data point. They're going to need more of it. Let me get up to Fed meetings here. I want to be sure I quote this, March 22, so we get another inflation report before that meeting. I'd tandem them together. I'd make a 3-month moving average and annualize that puppy.
The Federal Reserve Chair turned around and said the disinflationary process has started. Mike McKee, does this morning's data support it or contradict it?
It seems to support it because he was basically looking at goods prices versus services prices when he was talking about that, and it does look like we had a decline in goods prices to a year-over-year rate of 1.4%, down from 2.15% in December. So a change there. Service prices continue to go up, 7.16% in December. That was 7.05. So we have some goods disinflation. We don't have services disinflation yet. A couple of notes on what has come in here in terms of changes. Rents at this point up 0.8. That's the same as in December, and owner's equivalent rent down 0.1 to 0.7, but that's still a high number for housing, which is why the Fed wants to take that out and see what's happening with other aspects of housing.
We'll talk to Stephen Stanley about this, and Liz Ann Saunders talking about housing matters, and I'm looking at an annualized basis here, and the trend is what our viewers and listeners feel. Back to October, Mike McKee, 6.9% owner's equivalent rent, 7.1%, 7.5%, and the latest print, unless you want to correct me, is 7.8%. Those are still big numbers, and that's what we're feeling out there.
Yeah, those are still big numbers, but it's the way that the CPI is constructed takes into account rent for the whole year. So it takes a year for that. For new rent prices to get into the components, and we've seen that the most recent numbers, according to other aggregators, are that the rents are coming down.
John, the nowcasting here in the markets is something.
It's something else, isn't it? I'm not going to try and explain this. Yields were down going into the print. Yields were up after the print. They're now down aggressively. They were down by 9 basis points at one point on a 2-year. They're now down about 3 basis points. You can lose that word aggressively. Lisa, things are all over the place off the back of the print.
Okay, 2-year yields are yo-yoing. I mean, this really looks like a kid trying to play with a yo-yo. I don't understand. Stock markets basically rally's going to rally. That's all I can say, and that's basically where people are going to take this, because you're seeing inflation that by some metrics are hotter than expected.
Is that a job interview for Brad? She's trying to move to Wall Street.
Rally's going to rally.
Rally's going to rally.
Rally's going to rally. That'd work on the sales side. They'd love that.
Well, that's momentum. That's the momentum trade broken down for the millennial.
I'm going to run and leave you to it, and you find someone who wants to explain this. At the top of the hour in about 25 minutes, I'll catch up with Mohammed Al-Arian. Looking forward to that conversation.
She's going to say rallies are going to rally.
Mohammed's probably not going to say rally's going to rally. After we've broken down the data with him and talked about what it means for the Federal Reserve, Mike McKee and I will catch up with the Richmond Fed President, Mr. Barkin. So that's going to be the first Fed speaker off the back of this data, Mike.
Yeah, that's going to be fascinating to see. I suspect that given the market reaction, his reaction will be, could be good, could be bad. It's just like, how do you... what it looks like is this came in as expected. Some people were leaning one way. The first 5 minutes is always a roulette wheel in the markets right after the data come out. So probably not a huge thing. A couple of notes. New cars were up 0.3. Used cars down 1.9%. And that's sort of continues the trend. It was down 2% in the month of December. So still getting some benefit there, although that's likely, they say, to turn around. And we did the services shelter apparel prices up 0.8. A bit of a surprise because you would think that the clothing would go on sale right after the holiday period.
What we're going to do here, folks, Mike McKee's going to dive into the data. I can see over here out of my left eye here, he's got columns and columns and rows of David Rosenberg-like data. He's going to dive into that. And we have the privilege of continuing with Stephen Stanley before Kenneth Rogoff of Harvard University. Mr. Stanley is with Santander, their U.S. capital markets shop. Stephen, you've had time to dive into a first look at this interesting data. What's the adult take?
So it was largely as expected, but I would say it could have been worse. We saw a big decline in used car prices again. We saw a big decline in airfares again. Those things are not likely to continue for much longer. Medical care services prices were down 0.7. That's probably, an exaggeration of what we're likely to see in that category. So, and obviously there were upside surprises too, but my point being that some of these volatile categories that had been driving down the readings in late 2022 continued in January, and we still got a 0.4, which again, I think speaks to what we were discussing before, that as long as shelter costs are going up as rapidly as they have been, it's going to be tough to get inflation down anywhere close to where the Fed would like to see it.
This is absolutely critical. There's no other way to put it here, folks. And we see it from an equity strategist like Liz Ann Saunders, an economist like Mr. Stanley. The idea of housing is being overwhelming. How overwhelming is it, Stephen? Give us a percentage of our lives that are based off the set of housing data you have.
Sure. Well, the CPI, I think, maybe exaggerates a little bit, but if you just combine rent and owner's equivalent rent, those two account for a little over 40% of core CPI. So when we talk about, the super core idea, I mean, we're taking out a big chunk of the numbers. Now, the weights are a little bit smaller in the PCE deflator, which is the inflation indicator that the Fed most closely focuses on. But yeah, I mean, within the CPI, housing is maybe the story.
We're going to talk here with Stephen Stanley of Santander. Michael McKee is digging into the data, and we're thrilled to bring you Kenneth Rogoff of Harvard University with his perspective here in a bit. We're commercial free here to the top of the hour. Lisa?
Yeah, as we watch the yo-yo action in markets, which really builds on what we've seen so far this year. I mean, it's like a child's toy, what's going on right now in markets. And I am wondering, Stephen, whether you're looking at the inclination to rally, which is something that we have seen so far this year. How much of a challenge does that present to a Federal Reserve that on the margins is seeing the disinflationary process that is too slow for comfort?
Yeah, well, I think, the markets and the Fed have not quite been on the same page for a while now. The markets have, embraced slower inflation late last year. The markets want a quick Fed pivot later this year. And the Fed has been trying to push back against that to no avail. I thought, Chairman Powell had a nice chance to really kind of, push back at the FOMC meeting when he was asked about financial conditions, and he didn't. So I think the Fed has taken the tack of we'll let the data, determine how the markets react, and we think the data are going to play out in a way that will get things closer to where we think they should be. Yeah. It's always a dangerous game when the Fed tries to influence asset prices.
It's a dangerous game when they try to influence asset prices, and yet traditionally this was one of their main transmission mechanisms of monetary policy. How much do they get further away from their goal as financial conditions, by most measures, ease substantially to some of the lowest levels going back, some of the most accommodative levels going back to early 2022?
Yeah, and there's no doubt. I mean, as the minute the markets sniff, that the Fed might not have to go quite as much, financial conditions ease. So in some ways, it kind of it's a self-equilibrating process. But from the Fed's perspective, the concern is that even if you get somewhat weak real economic data, inflation might prove sticky or stubborn. Yeah. And that's the scenario that the market really hasn't been willing to contemplate much.
Stephen Stanley, thank you so much with Santander this morning. Diving into the data, Michael McKee here. Is it this time is different, as Rogoff would say?
This time is better. I mean, I can give you a good reason if you want to be optimistic now.
Please.
And we can all go home and forget about the Fed because inflation is licked. The supercore, we have the number now. It comes in at 0.27. So 0.3% gain during the month of January. That compares with a 0.4 gain, 0.37 for the month of December. So take out housing, and as Stephen said, you got 40% that you're whacking out of the CPI, and in terms of the core, and you've got some progress. So we're still seeing some gains.
Come on, isn't this too cute at a certain point? I mean,
sure.
Especially if you take a look at some of the aspects, you strip out everything and you get what you want to get. This is massaging the data. And on one level, I understand. On the other level, you've seen some reinflation in areas like used cars. You've seen reinflation in areas, including, a whole host of different metrics. So how do you sort of parse out and be this nuanced about it?
I think the key is you said you can strip out stuff and get what you want to get. The Fed's not trying to get anything. They're trying to get a measure. They're trying to use it as a measure of what inflation is doing. And because housing is such a big part of CPI, it distorts the rest of the price movements. And so if you want to see what's going on there, you kind of take that out. And it doesn't mean that inflation is gone, but it means there's progress in things other than housing, which is going down. It just hasn't worked its way into the system yet.
Michael McKee, much more on this, and of course joining John Farrell here in a bit. I believe he'll be on radio with us as well. 4.53% on the 2-year yield, an elevated 2-year yield, red and green on the screen now. Lisa will tell me when we jump up or down a substantial amount here
now,
in the next cup of coffee.
It's
this
literally
is a joy on a busy inflation day to have Kenneth Rogoff with us, to say he's professor at Harvard University, his work for the nation at the International Monetary Fund defies a description of "This Time Is Different," a seminal book here that is must read, must own, but far more his courageous "The Curse of Cash," which was out a number of years ago on this inflation day, on this day where Lyle Brainerd will join the White House. There's things to talk about, but we will talk about crypto here in a moment with Professor Rogoff. Ken, thank you so much for joining us this morning.
Hey, great to be here.
There's some people making news on inflation. One of them is a guy named Summers, who I think you've got a nodding acquaintance with at Cambridge. Is the character of this inflation the shock disinflations pre-Eisenhower 47 and through the 50s? Is it like the 60s and the worry pre-Volcker, or is this a different inflation?
Well, I think the Fed clearly is more alert than at an earlier time. On the other hand, I think, as Lisa's been saying and others, inflation's still here. The economy is still strong, and I think they have to decide how to play it. And one thing I think people maybe aren't paying enough attention to is that when inflation comes down, don't be sure interest rates are going to come down as much as people got used to before 2022. I think the next decade we're going to land at a higher real interest rate than we did before. So it's not just where the Fed doesn't just have to figure out, how much is inflation. They have to figure out where do we put the interest rate long term so that we don't have inflation.
My book of the summer is Olivier Blanchard's new monograph that's out. That's just absolutely brilliant on something academic, R-G, to keep it simple as well. The heart of Professor Blanchard's thesis is there's other things going on here we're really not observing right now. It's just not as cookie cutter, as simple as all the simple analysis that goes on day to day. What's a thing going on here post-pandemic that changes our finance, and particularly, as Olivier talks about, changes our debt analysis?
Well, I think there are two things. One is, I think inflation-adjusted interest rates are going to land higher than Olivier does. I think if you look at history, yes, there's a slight downward trend in the inflation-adjusted interest rate, but it's very tiny compared to how much it fell after the financial crisis. And I think there's going to be more mean reversion than perhaps he does, but who knows? I mean, that's a lot of uncertainty. And I'd say a second point is China is not going to be the same in the next decade as they were in the last decade. Yeah, they're rebounding off COVID lockdown, but I think that's also really going to, those are two big changes in trends that we're going to see after the pandemic that we didn't have before.
Why then is it important for there to be essentially tighter financial conditions for longer, right? Because higher real interest rates imply it's not just an inflation story.
Well, we had lower financial conditions for longer for a long time because people were scared after the financial crisis. Saving was really high, investment was really low. Now we've entered an era where debt has really gone up quite a bit, private and public, which leads to some adjustment in the interest rate. Probably defense spending is going to go up. Spending on green transition is going to go up. More populist governments from Latin America to the United States to Europe. So I think there are a lot of factors that will lead to more of a normalization.
So people are listening to you and they're thinking to themselves, is that good or bad for stocks? Ultimately, is this good or bad for the markets? Because that's sort of how people have viewed all Fed actions in recent years. Basically, tighter financial conditions have been bad for markets, and yet an effective tightening has allowed markets to rally that much more. Can you see that sort of sustained momentum of financial markets, even in the face of tighter monetary conditions, of higher real rates?
So higher real rates will mean lower asset prices in general. But what's going on right now, of course, is that the economy is stronger than we would have guessed if the numbers were right from the last labor market report. And that was incredible. It was eye-popping. Then the economy is doing pretty well, and that's good news. So if the interest rates are tighter from that, that's obviously good for markets.
If you're just joining us on radio and television, welcome to Bloomberg Surveillance, a key inflation report. Lisa's monitoring. Can I say green on the screen now? I think just here for the last
I don't know.
Second. Futures up 3, and there's some serious gyration going on here before we get to the opening. VIX 19.41, the 2-year yield 4.52%. We're thrilled to have a substantial conversation this morning with Professor Rogoff of Harvard University. Long ago and far away, you exited the IMF, and then Blanchard was there with Stiglitz. In post-GFC, they looked at 4% inflation. What an uproar that ensued. And then I would suggest that Peterson, Adam Posen has talked about 3% is a new appropriate level. Are we going to get away from an anchored 2% verbiage? Are we going to reset? I got to make some news here. Ken, help me. Are we going to reset this morning higher than a 2% level?
I'm not going to be able to help you, Tom. I think that's extraordinarily unlikely and frankly not a good idea. Yes, probably back in the day, they should have set 3% instead of 2%, but they didn't. And, they've really made commitments. If you change it, it means you might change it again. So I think what in fact will happen, I don't think we're going to have a soft landing, by the way. I think we're going to have soft, but not the landing. I think inflation's, they're going to allow to be elevated for longer, but they're going to say it's going to get back to 2%. We're just taking longer. I think that's going to be the rhetoric.
I want to shift here to China, as you mentioned earlier. And to me, what's so important, Ken, and I mentioned there's this guy named Obstfeld who wrote a textbook a few years ago with a guy named Rogoff. I think it's 9,000 pages long. It's like in the Game of Thrones where they take it off shelf.
It just feels like
it just feels like that. But Ken, what's so important here is we go from Obstfeld and Rogoff to the work that Lau Brainerd did with David Reicher 20 years ago on trade and labor. Sum in your international economics with a challenge Dr. Brainerd is going to have at the White House with this evil thing out there now, China. She's expert on trade and labor multinational dynamics. Where are we heading on that with China?
Well, first, let me say I have the utmost respect for Lael. I actually worked under her at Brookings when I was a visiting scholar in her section. I've known her for a long time. She's terrific. I think trade economists are looking at the data so far and saying, what deglobalization? Everybody's talking about it, but it's not in the data yet. But if you look at the tensions with China, and I have to say, particularly if something goes on in Ukraine, say with Russia really escalating with nuclear neutron bomb or something, and China continuing to trade, we are going to have to be talking about secondary sanctions, which we had done with Iran and North Korea, but we've absolutely not done with Russia. You want to trade with Russia, it's your business, it's fine. And then that really will be something. And a lot of the effects we saw in the labor market could be partly reversed. But short of that, it's modest, the changes that we're likely to see.
The shift from Lau Brainerd from vice chair to the head of the Economic Council for President Biden does highlight also the very political nature of making some of the decisions that you talk about, the sort of Adam Posen take on it, the Kenneth Rogoff take on it, that the Fed will allow inflation to remain higher for longer. How much is that a response to the sort of deglobalization that policy is going to hope for, this admission that you don't want to kill the economy? How political is that decision of allowing inflation to run hot heading into later this year?
Well, I personally have long said I just thought it was the right decision because basically we don't know what's going on. The labor market, has all these distortions that are coming off. The economy has all these distortions that are coming off. And you don't want to, race ahead like what you're doing for sure. I wouldn't be surprised if interest rates end up at 6 to bring down inflation. But why do you want to get there right away? Why do you want to rush to that judgment? Maybe they're going to end up much lower. So I don't think it's clearly very political at some level because growth is strong, but inflation's high. Which way do we choose? That is a political decision. It affects people differently, but the Fed tries to approach it in a technocratic way.
What he just said there, that rates could get to 6%, but why rush it, right? This is an important point. So do you think that it is appropriate to do 25 basis point increments, or do you think that they should just sort of sit on their hands and wait for a number of months to really get underway since there isn't a rush, in your view?
honestly speaking, either strategy would be reasonable at this point, but they're kind of committed, I would say, to do 2 quarter-point hikes at this point, given the labor market data, given the inflation data. And I don't think it matters a lot one way. It would matter more if suddenly we don't know what they're doing. But I think the real message is that who knew what was going to happen with the labor market report? And so I think there's a lot of uncertainty around, and that means to move slower and cautiously, but you can't predict too far ahead.
Ken, I'll turn to Chandler, drive off the road. I remember post-Volcker, and Olivier mentioned this in his book, he and Jeff Sachs wrote an essay in 1981, and boy, were they taken to task that higher rates can be not crucial for worrying about debt sustainability. So many of our listeners and viewers are scared stiff that if we get higher rates, or where we are now, or the 6% you talk of, that we're not going to be able to fund our debt and our deficit. Are they linked, or is it separate? Can we be comfortable with a higher rate regime given the debt of the nation?
Well, first of all, the United States is the global currency, so we have a lot of debt capacity. The question is how much it costs us. The real outcome, if we have too much debt, is that we'll get more inflation at some point. That's what just happened. We just had an effective partial default on debt. Inflation was much higher than anyone was expecting, and that put money in the government's pockets. That option's there. It's a soft partial default. That's what we're talking. We're not talking about not paying the bills unless some crazy people in Congress decide to do that.
I had no time for crypto. There's a more important question. I believe there's a vacancy at the Fed. Would you consider being vice chairman of the Federal Reserve System?
I don't think I'm likely to be a candidate for that, but thank you for asking.
It's good.
Because it's his to offer the job, so it's good that he checked in.
I'm just trying to make news. We're like 0 for 7 with Rogoff today.
I disagree.
6% inflation was very impressive.
No, 6%
rates.
There was a lot, though. This is a really important point because it was sort of edifying this Adam Posen view, where why is there a push to get back to 2% inflation? Are we going to get that kind of view? Even if you want to see disinflation, then at what point is it enough disinflation to be okay? These are some of the discussions at a time when it is a political decision and the economy is still strong.
I'm going to defend the land of Rogoff and that the common feature, even if they disagree, so he mentioned at the beginning he disagrees with Professor Blanchard, who's more quiescent about we can come back and the real rate can stay down and all that. But the answer is these people have a hard-earned humility by knowing the history of inflation. Fear is in Reinhardt and Rogoff. There's a humility here, Lisa, that I don't hear in the noise of Twitter and the noise of the rest of it.
Or the noise of markets where they're just flip-flopping back and forth trying to get a sense of what to do. And this is sort of the issue, right? We don't know where we're coming from and we don't know where we're going in terms of what inflationary shock we just experienced and what kind of labor market disruption that we're currently amidst.
Well, we're going to have to see here 4.53% of the 2-year yield again on the 6-month T-bill, hearkening towards where Professor Rogoff is talking. A 5% print on the 6-month T-bill is something new, certainly in the next 6 months. It has been an extraordinary show. Thank you to our team here for making this hour so interesting. Ken, thank you so much for the generous time this morning. We will drive forward the conversation in the next hour. Thomas Barkin of the Richmond Fed. There's a culture there, a fabric that is so different. Barkin of Richmond with Michael McKee and John Farrow. Stay with us. This is Bloomberg. Good morning.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
MasterCard introduced PayPass, its first contactless payment system, in 2002, but the technology took some time to gain traction.
I would say we first invested in this many years ago. The adoption rate on this in the early part, even in markets like the UK, Canada, Australia, was fairly slow in the early part. The inflection point of when it really started to hit its stride was when it was used in the transit vertical. So what we figured is, let's get all the transit systems around the globe enabled for contactless technology. That will create muscle memory for the consumer who will like the experience in transit and will use it elsewhere.
How do you judge the revenue proposition for MasterCard with an innovation like that and the adoption and the pace of it?
Look, I mean, for us, we're agnostic as to whether somebody's using the chip technology or the contactless technology or, using the mag stripe, which was the old way of doing business. We earn revenues which are quite similar across both of those. The revenue potential and upside for us comes from the fact that now more spend is being done on card-based forms of payment than was being done in the past. So we're converting that cash over to electronic forms of payment, which is where the incremental revenue comes from.
If contactless payments is the current revolution sweeping the payments industry, what's the next one?
I think pay with your smile. So, biometrics.
Suppose somebody is watching and says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Live from New York City this morning. Good morning, good morning. A beautiful morning in New York, and trying to figure out what that inflation report means for this market. Equity futures slightly negative. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York, coming up, the CPI report falling in line with expectations, keeping the pressure on the Fed to keep on hiking as the White House zeroes in on Vice Chair Lael Brainerd. We begin with the big issue, inflation in America.
A big CPI report
on Valentine's Day.
It was largely as expected.
Powell essentially is telling us they're data dependent.
He basically said, all right, you guys want to play data dependent? We'll play data dependent.
We'll let the data determine how the markets react.
That CPI print is kind of a sneaky risk event.
How long the CPI can really persist.
Investors have largely assumed away inflation risk.
How sticky will inflation be around this very critical 4% level?
It could be the case that US CPI comes in hot.
It's the kind of thing that could A, disrupt the rally, and B, I think embolden people to kind of lean against the rally we've seen.
I would say it could have been worse.
Mike McKee, it could have been worse, apparently.
Yeah, I like the way Steve summed that up. It could have been worse. A lot of that because much of the movement we saw in January had already been priced into the markets, even though they're trying to figure out where to go from here. The headline number up 0.5, which was as forecast. Now, that's a change from a 1/10 gain in the month of December. And the core up 0.4, a change from the month of December as originally reported, which was 0.3 gain. So we do see some hot CPI numbers. A lot of that in the headline is energy prices, both natural gas and gasoline, going up significantly. Also, we saw apparel go up, a bit of a surprise given it was January. Usually you get sales, so that may be a seasonal adjustment factor. On a year-over-year basis, as you can see, we ticked down in both categories of headline and core. Good news in the sense that it continues the progress that's being made. Now, what the Fed has been wanting to see and what we've been talking about for a couple of weeks here is Jay Powell's so-called super core, when you take out housing from the core rate, what do you get? You get a lower number. And at this point, it looks like some progress still being made. If you want to take some good news out of this, that's the one to do. The yellow line there, it's up 0.2, well, basically 0.3 for the month of January after a 0.4 gain in the month of March. It shows you that housing still has a major impact. You can see with the white and blue lines that goods prices are still going down, services prices are still going up, but a lot of that is housing. And so when housing starts to go down, we could see inflation start to fall fairly significantly. What's happening in the markets and how is that affecting the overall mood of the Federal Reserve? We'll find out more at 9:30 with Tom Barkin. But here's what the trading for the Fed funds in terms of the March meeting and then into July for the peak funds rate. It's gone up right now. We'll see if it comes back down. It looks like it's going up and down. So it's kind of hard to tell, but basically people try to figure out where we are at this point. And my guess is we're going to end up where we were before all of this, John, because as I said, the idea that it was going to come in a little hotter was priced in.
Yeah, this market was all over the place, and now it's basically unchanged on the S&P, down about 0.1%. Mike McKee, thank you, sir. Looking forward to catching up with you again in about 27 minutes' time. We'll be speaking to the Richmond Fed President, Tom Barkin. Do not miss that conversation. The first Fed speaker to react to this number coming up in about 25, 27 minutes. I'm pleased to say that we get the first reaction now from Mohammed Al-Erin of Bloomberg Opinion and Queen's College, Cambridge. Mohammed, wonderful to have you with us on the programme, sir, as always. Your reaction to that print from 33 minutes ago?
So, John, my reaction depends on what I'm comparing it to. It's in line with consensus forecast. That's good news. It is not as bad as what some people were starting to worry about in the last 2 days based on very partial indicators, used cars being the example. And it is still too high compared to where we thought we would be a year ago. I mean, inflation is still too high, and on a monthly basis, it has gone up. I say this, John, because it's really important to be humble about our ability to forecast inflation over the next 12 months. There are a number of scenarios. None of them dominate in an absolute sense. And it's really important to keep an open mind as to the price formation process. And we can talk about the details of this, but just we have to keep an open mind. Let's not jump to one particular scenario because there simply isn't enough evidence to support one particular scenario.
Mohammed, let's talk about that now. You wrote about it in the last week in Project Syndicate. You talked about the disinflationary process beginning, referring to what Chairman Powell had told us a couple of times. You said this thesis may be comforting. It could also encourage dangerous complacency. How high is the risk of that now?
Very high, and the marketplace embraced it, and we saw the 2-year go down almost to 4%, 4.02. We're back at 4.50. You know, we embraced it. We love comforting news. We love, you know, when someone said inflation, we said transitory. When someone says possibility of recession, we respond short and shallow. And then when someone said disinflation, okay, we repeated many, many times, and we assume that it's just going to happen, what some people have called immaculate disinflation. So we have a tendency, John, to immediately go for the comforting narrative. And that, as we have seen with transitory inflation, means that we fall behind. What I'm saying here, just let's keep an open mind. I think the most likely scenario, and I give it 50%, is that we end up with sticky inflation, 3 to 4%. There is a possibility of an orderly disinflation. I give that 25%, and there is an equal probability of 25% of a U inflation, that we find out that service inflation is very difficult to bring down, including the so-called super core, and goods disinflation stops as we're seeing it happen now and starts going up. So when you're looking at 3 scenarios with very different market implications, and you can't give a deterministic probability to any of them, it's really important to keep an open mind.
That makes it incredibly complex to be a policymaker who has to confront the probabilities of each of those 3 scenarios and set policy. Mohammed, they've been talking about being sufficiently restrictive now for the last couple of months. Are we there yet in your mind? Do you think we are sufficiently restrictive?
Not for inflation and not for a 2% target. Look, John, ironically, it's less hard for policymakers than it is for market participants. It's really hard for market participants. for policymakers, you've got to think in terms of what mistake can I afford to make? And the mistake you can afford to make right now, given the underlying strength of the labor market and given how our economy in general is doing, is of paying too much attention to persistent inflation. So it's better to get the inflation genie back into the bottle than to relax too early. And you've heard me say this before, and I certainly wouldn't say the word disinflation 11 times in a press conference, because that's all that the market will hear. And in fact, it was all that the market heard.
And the market ripped and rallied off the back of it. Now, Mohammed, I wonder, as we get this incoming information, with CPI to one side, what we're learning from retail sales tomorrow, what we might find out, what we've seen from payrolls already, is it too early to say this when people start to conclude that maybe the economy is less interest rate sensitive than they thought it was? Can you draw that conclusion?
So it depends on which part of the economy, John. The reason why economists really worry when inflation is allowed to get embedded into the system is because it will migrate to sectors that are much more difficult to get to via monetary policy. Services is an example of that. So if it's housing inflation, you can get to it through monetary policy. If it's goods inflation, you can still get to it. When you get to service inflation, in order to get to it, you end up creating quite a bit of collateral damage in the process. That's where the worry is that we've allowed inflation to migrate to the service sector, and with that, it becomes harder to control. And that's, I fear, that is what we're going to see when inflation gets sticky.
So Mike Gapin of Bank of America has said there's evidence that this US economy is difficult to slow down. I mentioned Andrew Hollenhorst, the Citi recently, who said the data's pointing to a longer expansion. Vishy Tripatura of Morgan Stanley saying the same thing. The hard data's too hard to ignore. In your mind, Mohammed, since this year has started, are you pushing out the length of this cycle at the same time you think the risk might be increasing, inflation is sticky? Are those two happening hand in hand?
John, I remember being on your show when Bloomberg came up with this very dramatic headline, which you've maintained for a while, 100% probability of recession. And I said, no way, it's not 100%. It's not even close to 100%. Yes, there's a possibility, but it's not 100% probability. We can avert a recession. And the last few weeks of data suggest that we can still avert a recession. Now, that's a good thing. I want to stress that is a good thing. That's not a bad thing. That is a good thing. If you look at the internals of the data, just look at food inflation in today's print. It's very easy to see that it is the most vulnerable segments of our population that are suffering. So the last thing we want to give them is income insecurity on top of eroding their purchasing power on essentials. So I'm hoping that this strength of the economy stays, because the alternative, John, of a deep recession to get to a 2% target that is itself arbitrary, I'm not sure that that is the right response.
Are you saying the 2% target should be pushed aside, de-emphasized?
So it is very difficult to change a target when you have missed it for so long, because the minute you do that, your credibility is hit even harder. I think that if people sat down today, they would not come up with 2%. They would come up somewhere between 3 to 4% for two reasons. One is that the supply side is changing, and you need relative and absolute price changes to lubricate that change. And the second is we found out 2% is not far away from the zero bound. We thought it was, but it's not. So we'd go to 3 to 4%. I think the most likely outcome, John, and you and I have discussed this, is that inflation gets stuck at about 3 to 4%. The Fed keeps on promising us 2% in the future. And hopefully we learn to live with stable 3 to 4% inflation, and then we can make something de facto de jure.
You've been very critical of this Federal Reserve, rightly so, over the last couple of years. No doubt about that. You said they need to be open-minded, more open-minded about what's happening. Now, we had one viewer write in a question on the Bloomberg terminal who said, do you think the fact that the Fed has said they are data-dependent, does that mean that the Fed does have an open mind? Is that evidence of that?
No. Data dependency means I'm short-term, okay? If you think of what the Fed is trying to do, it is trying to combine data dependency, short-term, with the reality of long and variable lags for their tools, longer-term, with the correct observation that Chair Powell made last week that some issues are more structural than cyclical, right? So it's data dependency by itself is not keeping an open mind. You've got to also be open to different scenarios and sit down and figure out what are recoverable mistakes, what are non-recoverable mistakes. When we look at multiple scenarios, the likelihood of making a mistake goes up. It's not that you want to make a mistake.
Yeah.
It's just that the world has become, as Larry Summers said on your network, it's a very difficult economy to read.
He often says that to David Weston. It's an incredibly difficult economy to read. So let's finish on the policy suggestions. Mohammed, I think the one key risk for a lot of people in this market over the last 18 months has been the risk of a bigger terminal rate, a higher terminal rate, the upside risk around that issue. Do you think that's still pronounced? And if you had to take a best guess now, and this is slightly unfair of me to ask, but if you had a best guess for the terminal rate, what would it be?
It'll probably be higher than it is now, than what the market has priced in, I think at 5.15 last I saw. And then we would stay there for a while. We wouldn't come down as the market thinks. The market thinks that by the end of the year, we'll be down about 25 basis points from that peak rate. I don't like calling it terminal rate. I like calling the peak rate for the cycle.
Drop the jargon, essentially. Mohammed, thank you. As always, just wonderful. Mohammed Al-Arian of Bloomberg Opinion in Queen's College, a good friend of this program, and a brilliant mind on the economy and on the Federal Reserve. We're going to catch up with Tom Barkin of the Federal Reserve and the Richmond Fed in just a moment, about 20 minutes away. Don't miss that conversation. Equity futures right now down 0.25%. Yields higher by 5 basis points, 456, pushing 457 on a 2-year. Coming up, inflation in America picking up.
As long as shelter costs are going up as rapidly as they have been, it's going to be tough to get inflation down anywhere close to where the Fed would like to see it.
More on the CPI report with Nuveen Sarah Malik, Krishna Mamani of Lafayette College, plus that Fed exclusive coming up shortly.
make it very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much like the consumer is paying them. And so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value and the kind of transparency that they want.
Are you seeing a labor shortage right now? And what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about like going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Was largely as expected, but I would say it could have been worse. Some of these volatile categories that had been driving down the readings in late 2022 continued in January, and we still got a 0.4. As long as shelter costs are going up as rapidly as they have been, it's going to be tough to get inflation down anywhere close to where the Fed would like to see it.
A hot inflation print coming on the heels of a blowout jobs number, reinforcing the Fed's message of higher for longer. The report also, of course, keeping the pressure on the White House. A bit of news on that. President Biden zeroing in on Fed Vice Chair Lael Brainerd to lead his economic team. We make an announcement on that as soon as today, according to our reporting down in Washington, D.C. Before we get to that, equity futures right now down about 1/3 on the S&P. Yields a bit higher by 5 basis points, close to 457 on a 2-year. Here with us to talk about that CPI report, Nuveen Saramatic, Krishna Mamani of Lafayette College. Let's go first to you, Sarah. You were looking for a hot print. Your response to what we got?
Well, there's something for the bulls and the bears in this number. The number's not as bad as feared, but if you look under the hood, very sticky shelter prices up 0.7, and also used car prices down, but we've seen the real-time data where used cars prices are increasing, so that's yet to come into this number. Key question is, what does it mean for monetary policy? I think it brings back the likelihood of a third interest rate hike. My concern is around market valuations, which are up a few ticks year to date, and also these high beta stocks that have rallied quite strongly. I think that's where you're at biggest risk of an unwind in the markets, given inflation is sticking around for the time being.
Krishna, coming into this, you said even if it was hot, it won't alter the policy path meaningfully. Is that still the case?
Oh, absolutely. First, it wasn't hot, so that was a bad assumption on my part. But the policy path, the Fed has actually articulated that quite well, which is what they're focused on really is the labor market. And I think the January labor market report was far more important than the CPI report. If we see a few more of those, then we'll have a potential problem on our hands. But hopefully that gets washed away. But the core thing that the Fed is focused on is really the labor market, the tightness, and the wage growth. And that matters a whole hell of a lot more than anything else.
Well, we've got to talk about the equity market as well. Futures down this morning by 1/3. Marko Kolanovic of JP Morgan had a tough time last year calling this market. He was bullish as it was selling off. He turned bearish as it rallied. He says this on this equity market right now. We see the equity risk reward is skewed to the downside. Do you see it the same way, Sarah?
I think probably after the year-to-date rally we've seen, it likely is skewed to the downside because we're pricing in a soft landing. My concern for this year is earnings, already in fourth quarter earnings. Margins are seeing declines. We were expecting to see that. I think the next shoe to drop is pricing and revenues. Revenues are expected to grow this year. And also 2024 earnings, or consensus is up 12%. Those are going to be hard numbers to meet if the impact of monetary policy finally comes through and we do see some form of an economic slowdown. So I think that's going to be the issue, and that's why valuations will have a hard time staying where they are because they're at a premium.
This rally has been so painful. It is the ultimate pain trade. The S&P year to date up 8%, the Nasdaq something like 14% higher. Krishna, you said it a few times on this program already this year. You said this is the pain trade. 4,500 maybe on the S&P. Is that still the case?
Oh, absolutely. I think given where nominal growth is, the likelihood that the equity market goes down on its own is pretty small in my judgment. So I think that's what we are dealing. The onus is really on the bond market to take the equity market down. And off late, they have started playing a bit of ball, but I think relative to the message of the Fed, which is they're going to get to terminal rate at some point and stay there for a long period of time, the bond market doesn't believe that. And I think until it starts believing that, the upward path in stocks probably persists for a little bit longer than what most people think.
Krishna, is there a disconnect between what's evolving right now with a 2-year yield up 5 basis points to 457? Only a couple of Fridays ago, the morning of payrolls, we were threatening to break 4% on a 2-year. We're higher by more than 40 basis points since then. Wasn't even 2 weeks ago. Krishna, I'm seeing that take place, and yet the equity market seems pretty resilient. What is the connection between what's taking place in bonds and what isn't taking place in equities?
I think what hasn't changed, and the reason why equity markets haven't come down, is we are still expecting rates to be lower by the end of the year. I think that particular issue has to be resolved by data, because that is really the disconnect between what the Fed is telling us and what the bond market believes, and which is getting priced into the equity market. I think we have taken some of it off, but we still are far more sanguine than what the Fed would like us to be.
Disconnect is a word that keeps coming up on this program, Sarah. Morgan Stanley have talked a lot about a disconnect in this market between what they think is disappointing earnings and what other people would agree on, and what's taking place in equities. Sarah, what do you make of all of this? Is there a disconnect?
I think there is a disconnect. Look at the yield curve. It's been flashing a recession warning. But the question is, when is that going to happen? And with the strong employment numbers, the strong consumer numbers that we're seeing, it likely pushes off the timing of a recession. And that's what the markets are trying to understand. So, we're watching that closely, but I think the recession question could be later this year. It could be in 2024. Until then, you could see the market continue to be in this trading range, continue to muddle through as it tries to determine when should we price in the recession. Odds of rate cuts for us are off the table for end of this year. I don't think you're going to see that until you hit that recession. And this strong economic data, particularly in the employment market, tells us we're not near one anytime soon. But we have not seen the impact of what the Fed has done in terms of tightening yet hit the economy. Therefore, I don't think we can rule out the idea of a recession from the table.
Staples did their job last year. Let's talk about the bucket of this equity market you want to be in, Sarah. Staples did their job last year. PepsiCo put out some decent results. Coke this morning. I know you like the latter. Can you tell me why?
Yeah, we do like Coke over Pepsi. We love their geographical diversification. The fact that they're focusing on growing revenues completely rather than just on volumes. They've been a bit of a laggard versus Pepsi. So we thought all that was a nice setup for Coke going forward. Overall, all Staples, though, we like dividend growers even better, which is not just Staples. These are companies with strong balance sheets, ability to continue to grow their dividends. They look cheaper than just some of these bond proxy areas such as Staples. So I'd say selective in Staples, Coke over Pepsi. But then look at these companies that can grow their dividends, low volatility, provide income to shareholders while we own the companies.
Cautious approach to what you think might be a difficult year. Sarah Malik there of Nuveen, alongside Chris Mamani of Lafayette, who's taken completely the other side of this, at least in the short term, who thinks that pain trade's 4,500 on the S&P. Thank you to you both. Equity futures down 1/3 of 1%. Coming up, the morning calls, and later, an exclusive conversation with the Richmond Fed President Tom Barkin and Mike McKee just around the corner. Looking forward to joining that one. We'll do that in about 7 minutes' time.
Typically, between the time you start and they get out in the farmers' fields, is about 8 years. Now, we have a pipeline of innovations. We've been funding the CG system for 20 years now. It's funded at about $1 billion a year. If people care at all about adaptation, that thing will be funded at $2 billion a year. I mean, there won't be anything close to the impact of climate-related seeds, climate-related maize, rice, wheat, sorghum, millet. And thank goodness, because of human genetics, we know how to do the editing. Thank goodness, because of AI, we know how to find the alleles. Because of drones, we can measure stuff in the field. So there's huge advance in terms of how the whole seed ecosystem moves at full speed.
Away from the opening bell. Equity futures right now down 1/3 of 1%. Let's get you some price action. The Nasdaq down 0.4 of 1%. And here are your morning calls. Evercore downgrading First Solar to inline, saying benefits from the Inflation Reduction Act are now largely priced into shares. Goldman upgrading Occidental to buy, highlighting the stock's recent underperformance and improving cash flow. That stock up by 0.5 of 1%. And finally, Argus downgrading Lyft to hold, seeing limited upside with intense competition weighing on margins. We're negative there about 2.2% at $10.23. Coming up on this program, an exclusive conversation with Richmond Fed President Tom Barkin. That conversation about 4 minutes away around the opening bell, with futures lower by 1/3 of 1%. And yields higher in the bond market by 6 basis points on the 2-year, very close to 4.58. Your opening bell up next.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of, like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
He's there to kind of upside.
24 seconds away from the opening bow this morning. Good morning to you. Equity futures shaping up as follows on the S&P and on the Nasdaq. Yesterday, a decent day of gains on the S&P 500, taking back the week of losses from last week, which incidentally was the biggest week of losses of the year so far. Equity futures negative 0.4 on the S&P. On the Nasdaq 100 down 0.5%. On a Russell, the small caps down 0.7%. That right there is your opening bow. Joining us now on Bloomberg TV and on Bloomberg Radio, I'm pleased to say that we're joined by the Richmond Fed President Tom Barkin alongside the brilliant Bloomberg's Mike McKee. You happy with that introduction, Mike?
I like that.
That worked for you? Good.
Yeah.
And the brilliant President
Barkin.
Tom, great to catch up. Thanks for being with us.
Yeah, thanks for having me here.
So we get some Fed speak 60 minutes after the inflation report. So let's start there. Your response to that CPI print we got a little bit earlier.
It's about as expected. Inflation is normalizing, but it's coming down slowly. And I just think there's going to be a lot more inertia, a lot more persistence to inflation than maybe we'd all want. Part of that is still COVID factors, excess money in people's pockets, supply chain issues in places like cabinets and switchgears. Part of it is business factors. There are businesses out there still trying to recover lost margin. But I think the biggest thing is that after the experience of the last couple of years, businesses have now understood that pricing is a lever again. And as I talk to the folks in my district, I'm hearing people still out there pushing price and trying to test where the levels of inelasticity really are.
So one thing we've heard from Fed officials, including the chairman, is that the disinflationary process has started. Is that something you agree with? Do you see much evidence of that? And where do you find that evidence?
Well, if you look at the 12-month numbers, you can see they peaked several months ago, and they're coming down steadily. But that's one part of the puzzle is inflation coming down. The other part is actually hitting our target. And so it's going to take a while to get to there.
Do the latest data that have come in, not just today's CPI, but the jobs report, et cetera, change your view of how far the Fed will have to go beyond perhaps what was in the SEP for December? And does it change your view of inflation dynamics?
Well, I try not to get too wound up in any particular data read, particularly a January data read, large seasonality factors, all that sort of stuff. But I do think what we're now in a position to do is to react to multiple months of data as they come in. We may or may not choose to take rates up further if inflation continues to persist, but we'll have to see what happens.
Well, based on what you're seeing right now in terms of the path of inflation, the dot plot said 5.13% in December. You think that's enough?
I think we'll see. We're going to get a PC at the end of the month, another CPI before the next meeting. And then I think as the meetings go on this year, we'll see what happens to inflation. If inflation settles, maybe we don't go quite as far. But if inflation persists at levels well above our target, maybe we'll have to do more.
Well, do you think that maybe you and the markets are on a different time frame? You're going meeting to meeting, and they're looking out towards the end of 2023, saying you should be cutting rates by then?
I'm not sure I understand markets. You guys are much better than I am. I'm very focused on what's happening in the demand in the economy. I'm very focused on what's happening to inflation. And I think the way to think about my view on rates is, were inflation to persist, we might have to do more. If inflation doesn't persist, maybe not.
How do financial conditions factor into that call, into that view? How do you think about financial conditions?
Well, there's lots of definitions of financial conditions.
How would you define it?
I think that as we raise rates, the market and all markets, sort of respond to how we're doing things in the path that we forecast. There are people who are out there saying financial conditions are back where they were a year ago, and I say, I don't know. It looks like rates are higher than they are a year ago. Certainly, if you're trying to get a mortgage, that's what you'd think. And so the financial markets make their forecasts, and lending conditions, whatever, work off of that. I think you can try to manage it, but I'm in the world of try to define your response function, try to live to your response function, and I think markets will catch up to what you're doing.
If we can dig a little bit deeper, we've had a decent equity market rally here today. Credit spreads are, I think, something like 200 basis points tighter than the wides of last year. Do you see that as complicating your ability to tighten financial conditions and bring inflation back towards target? Is it something that's on your mind a lot?
I think trying to manage markets, at least for me, is a fool's errand. And so I'm in the world of trying to manage what we can control. If demand stays hot, if inflation comes in elevated, have rates move more. There are lots of other scenarios of what happens in the economy, and we'll respond to those.
Well, one of the questions that people are asking is, does it make it harder? Does it is the market pushing back against you, and do you see inflation maybe stickier because of that? And is it a question of you have to raise rates higher or leave them in place longer and wait for the cumulative weight of tightening to hit?
Well, I think there's a very good case for leaving rates higher for a longer period of time to allow that tightening to hit. I do think the lesson of the 70s was very clear, which is don't give up too early. And anything I've read, and I've talked to lots of other people who seem to have understood that market, they say, if you go back to the Arthur Burns years, it was raise rates, economy weakens, lower rates, inflation comes back stronger, raise rates, economy weakens more, lower rates. That doesn't seem like a path that makes a lot of sense.
Does history weigh on you when you refer back to the 70s? Do you really feel the weight of that?
I've done a lot of reading about it, and I think, for better or for worse, we've got a really good episode where our predecessors did the right thing and got inflation back under control. And I think that's certainly an aspiration for me and for us.
You understand the view of market participants that when they hear things like the disinflationary process has started, they get the sense that we're moving away from that language, that we want to learn from the lessons of the 1970s, we want to be tighter for longer. They see that as new information. The first step, and you'll hate this word, the first step towards a so-called pivot. Why isn't it that?
Why isn't this a pivot?
The first step towards one. By acknowledging the disinflationary process has started, for some people, market participants that speak to us on a daily basis, they view that shift in language as a step away from the Chairman Powell address we got in Jackson Hole, Wyoming, which was 8 minutes, down the camera, super blunt, there's going to be pain, it's going to be painful, but if we don't do this, it's going to be even more painful. 4 or 5 months later, with an equity market rally in between and a bit of deceleration in inflation data, it's now the disinflationary process has started, and that's the focal point for so many people. Why isn't that the first step towards a pivot that says, okay, we can back away?
Shoot, I just try to keep it simple for myself, which is nobody really knows how inflation's going to play out over the next year, over the next 2 years. And so I think what I can do is talk about how I think about it. The way I think about it is if inflation stays elevated, if it persists, we'll have to do more.
Well, you struggle with what the markets are thinking, but you're probably very good on what companies are thinking because, of course, that's your background and you talk to CEOs all the time. What are companies thinking? You mentioned that some are still pushing the envelope on prices, but what's their outlook for growth and particularly employment and wages over the next 6 to 9 months?
So the way I put it is everybody's got a recession playbook. It's in the drawer. They've taken it out. They've dusted it off. They've updated it. Right, they have a very clear sense of if things were to turn south, what they do. For the most part, they haven't turned the pages of the playbook, and the reason they haven't turned the pages is that their business actually remains pretty sound. Now, that's not true if you're in mortgage lending. That's not true, obviously, recently in the tech world. But in most of the businesses I talk to, it's still not the point where they pull that. And part of it is they've really fought hard for 18 months to get workers. And they're really reluctant to shed workers if it turns out that they didn't need to. And so I think there's still a reluctance. And when you see things like the recent jobs report or some of the consumer spending data we've seen for January, you start to see that in the business's actual demand set. And they're saying we're not there yet. But of course, we all know the world could turn and they could get there. I just don't think they're there yet.
Well, that brings up an important question about your reaction function when you're predicting that unemployment is going to rise significantly because you're trying to clamp down on demand, and it doesn't happen. How do you incorporate that into your thinking about where you are?
Well, I think we've taken rates to where we've taken them. We've signaled, or at least I've signaled, that if inflation persists, I'll continue to respond appropriately. You do know that there are long and variable lags with rates. And so you're watching the demand side, not because the objective is to manage demand, but because the objective is to manage inflation. And so you're looking for signals that inflation comes down. You're looking for signals that demand is weakening, softening in places where that would be relevant to inflation coming down, and you play it out.
Can you explain longer variable lags to us? Because some people have come on in the last 12 months and they've said to Mike, they've said to myself, to Lisa, to Tom on Bloomberg TV and radio and said, they're not that long at all, they're pretty short. Financial conditions will price it all in immediately, they'll tighten, and you'll feel it pretty quickly. Are they that long? Are they that variable?
You didn't like financial conditions a second ago, and so we'll work on that. I do think we've seen in a number of sectors, particularly interest-sensitive sectors, particularly sectors where the strength of the dollar matters, you've seen demand move very, very quickly. And well before we started increasing rates, mortgage rates increased, and that, of course, meant the lag in that sector was less than the world where we used to hide what we're doing.
Yeah.
On the other hand, if you go in lots of other places, think healthcare for a second, a big part of the economy, it's not at all clear that the rate stuff we've done or are doing is having that much impact on demand there. I think that's where it takes more time. And the studies I've seen suggest that there's a period of time to go from raising rates to the impact on demand. But I think the real issue here is from impact on demand to impact on inflation. And that's really, when you talk about the long and variables to inflation, and then I get back to where I started. And I would just say, there's the sales department, the finance department. The finance department loves raising prices because it's the fastest way to move the bottom line. The sales department historically has been very nervous about doing it, either because of incentives or market share or whatever. After the experience of the last couple of years, the finance department has a lot more sway in that conversation than they used to.
So how would you characterize the balance of risks at the moment? With all of that in mind, and it's tremendously difficult to confront as a policymaker, Chairman Powell said repeatedly a few times last year that the risk of doing too little outweighed the risk of doing too much. Is that still the case?
It is for me. I mean, we're still in a 3.4% unemployment economy with inflation, depending on which measure you want to look at, well over our target, 6% on a 12-month basis. Feels to me like the risk is on the inflation side at this point rather than the economy side.
We are talking with Richmond Fed President Tom Barkin on Bloomberg Television and Radio. Thank you to all of our viewers and listeners around the world. What is your view in terms of the growth outlook at this point? It seems like we went through a phase of recession's inevitable, then, we're going to have a soft landing. You have people saying no landing. Where do you come down on all of that?
I keep trying to look at past recessions or past economic tightening cycles and ask the question of which this is most like. And of course, the ones that are most recent in our memory are all recessions where something winged in from left field, whether that be 9/11 or the financial crisis or the pandemic. And so I think we may be looking at an economy more like the one that I remember back in the early 90s, where there was a tightening cycle. And different sectors got hit one at a time. It seemed like much more of a rolling situation. And so the overall numbers perhaps aren't going to be as negative. Again, I'm assuming nothing comes in from left field, but aren't going to be as bad as the ones we remember them from 2 years ago or 15 years ago. But we'll see.
Well, when you sit down on March 22nd with your new projections for the economy, are you marking up growth? Are you marking down growth? What do you think is going to happen?
I've got a month before I need to make those projections. And I'm teasing, but I'm quite serious about it. We have a real serious process. We run multiple models on this. We take in all the most recent data. We will get another jobs report, one perhaps with less seasonality impact. We'll get another PCE and a CPI. And so I wouldn't want to front run our team and our models on that forecast.
Just in terms of risks around the view already projected from December, upside risk for growth, for inflation, for the terminal rate? How are you thinking about things currently?
Well, the biggest surprise has been the jobs market. I mean, the jobs report we got a couple weeks ago was quite significant and much stronger than what I had anticipated. And so the question in my mind is going to be, are we going to get another one like that in February, or are we going to get something in February that revises, corrects, moves it down? So I think that's really the key thing I'm looking at in terms of growth.
It's been surprising for all of us to see unemployment come lower. There was a take, I think, last year. Mike, you and I used to talk about it all the time. This is the Fed's job. They need to get unemployment up to get inflation down. And it sounded ugly, it was brutal, it was difficult to communicate as a policymaker. Do you still see it that way? Do you need to get unemployment up to get inflation down?
I see we need to get inflation down to get inflation down. And what I mean by that is, our tools work on demand, they work on lots of various things, but the key to this whole thing is getting inflation down. I don't start with unemployment, I start with inflation. And we'll see what happens on the employment market. We're still at 3.4% unemployment. That's a historically low number. You're talking 1969, and before that, 1951. And so, there's been a lot of talk about the jobs market so far, quite strong. We'll see what happens.
Are people in the companies in the Richmond district telling you that they are still having trouble finding people, or has that eased?
It's not as desperate as it was a year ago or a year and a third ago, but it's still very tight. On the professionals, though, I think that has kind of loosened. Some of the layoff announcements recently have sort of hit home. People trying to hire tech workers are having an easier time doing it. For the frontline service workers, still very tight. But people are getting by, whether it's lower service levels or not cleaning the hotel room every day. The place that's still screaming tight is skilled trades. Construction, nurses, truck drivers. We just don't have as many as we need. Demand in a lot of those places remains elevated. And folks are really struggling to find those folks. That's really where it's the tightest.
Let me ask you about the balance sheet. It's been running in the background. It's been paint drying, but there have been concerns expressed in the short-term money markets, and we're still seeing a lot of money put back into the repo facility. Is it working the way you want it to? Are you getting the results that you want, or is this also a case where the markets are not reflecting necessarily what you're trying to accomplish with QT?
I think we did a bunch of actions we thought important at the time in terms of stimulus and supporting the markets back in 2020. We're now trying to unwind that. I think our primary tool is the rate tool. It's not the balance sheet tool. The objective is to unwind the balance sheet expansion that we did and do it in a way that doesn't change any focus on our primary tool, which is the rate tool. You guys still seem to be focused on the rate tool, so I think so far so good.
We're focused on the balance sheet too, so let's stay there. I'm sure you're pleased that people see it as paint drying, but it's not. It wasn't just an objective to get the balance sheet up. You were looking for a consequence from doing that. You said the objective was to get the balance sheet down. Are you not expecting there to be a consequence there?
No, I mean, first of all, the analysis of the impact of balance sheet movements is unbelievably difficult, arcane, opaque, and tortured. And so I've really struggled as I've kind of come into this to come to ground to it. Where I've landed is it's got to be symmetric. If you believe that adding to the balance sheet does something, then you got to believe that shrinking the balance sheet does something else. So I've got no question about that. I do believe that on both the expansion side and the reduction side, it's a lot smaller than some of the estimates you'll see. And people talk about the impact of buying more bonds. There's also a signaling effect when you're buying. I think the signaling effect may actually outweigh the impact of buying the bonds. The signaling effect in terms of when you would finally raise rates or whatever. When you're shrinking the balance sheet, there's a shrinkage effect, and then there's a signaling effect. The shrinking effect, of course, I would say is parallel to the expansion. And then the question is, what is the signaling? The signaling tends to be around liquidity. That's the conversation that gets raised. I just would come back and say, compare today's balance sheet to 2018 or 2019's balance sheet. It's still so much larger that I have trouble seeing that liquidity is actually being driven by what we're doing right now.
Back at home, what worries the people of the Richmond district? I mean, we have the idea of a possibility of recession. We've got what's going on with energy prices because we don't know what's happening in Ukraine. There's this whole idea of the debt limit leading to a default. How much are people in your area focused on those things?
What I hear over and over and over again is that people hate inflation. And that's what they're focused on. I mean, people hate inflation because it seems unfair. I mean, you get a raise and then you spend the money you just got at the gas pump. It feels arbitrarily taken away, creates uncertainty, and it's just exhausting. It's exhausting to shop around for better prices. It's exhausting to defend your prices to a customer. And so people are really excited about the prospect that we might get inflation under control, but you don't have to look much beyond the sentiment indices to see what people think about inflation, and that still is the overwhelming conversation we're having.
I have to ask you this. It appears that at the Federal Reserve, you're going to be in the market for a new vice chairman. Lael Brainerd, what does she bring to the Fed and to the Open Market Committee? How would you characterize her tenure?
Well, I don't know what will or won't happen from the administration, but Lael's an asset. I mean, she's very smart, she's very capable, and she's an asset to us, and if she does something else, I'm sure she'll be an asset there.
She's been seen as one of the doves on the board. Is there such a thing, and was she?
We have 19 really, really capable people on the committee, and I listen to every one of them because every one of them brings in a unique view. And as we've learned in the last few years, people's views change as the data comes in. And so, I've got colleagues that you might think are doves who might go the other. I mean, I think so. It's I think people take the job very seriously, and they're very genuinely interested in landing the plane on whatever is actually the situation in the moment, as opposed to, I'll call it, a pre-existing leaning.
There's rarely any dissent. Why is that?
You mean dissents or dissent singular? Because I have the privilege of sitting in the meeting, and there's lots of points of view that are phrased. So I wouldn't be confused about the idea that there aren't a lot of different points of view raised.
Give us a bit more clarity on that, because from the outside looking in, sometimes it feels like groupthink. There aren't people that come out that say, I disagree with the decision and this is why. It's incredibly rare, particularly from the board. How much of that is actually taking place inside the building around these decisions that we're just not aware of? Why isn't this groupthink?
Well, I spend my time every 6 weeks, 7 weeks per meetings. I go into the market. I don't spend a lot of time in my building. I'm trying to figure out as best I can what's happening in the economy from people who are participating in it. I try to come up with my own points of view in terms of what's happening to economic conditions and where we ought to go with policy. And I show up with my points of view. And then every time I go there, I learn something. And I learn from people who are doing the exact same thing with their own independent views. I think the structure of the system is very well set up to gather independent views. And then, of course, the meetings are very well led in an effort to put those on the table and try to land on a place where, you can get some version of a consensus.
One of the things people have been critical of is that there are 19 members of the Open Market Committee who are speaking all the time, and it can be confusing to markets and to the public. Do you see that as a valid critique?
Well, I'm privileged to be here, so I guess if I say no, then I'm asking.
You're the only one that's allowed to come back regularly every day.
No more interviews after that.
Exactly. I see a huge part of my job as trying to translate what we do into the district that I serve. And so, like I said, I really am on the ground all the time. I'm doing chambers of commerces in small cities, and I think there's a real thirst for understanding, and I think there's real value to the people in our community hearing from and understanding people who they think are actually rational, not, people from Washington, if I can put it that way. And so I think there's huge value in that. You guys choose to cover it. I'll leave it to you whether that's the right thing to do or not. But I don't see it as getting on. I see it as actually talking to the constituents in my district.
Just one final question, and you've been incredibly gracious with your time, so thank you for that, Tom. It's the third year of pandemic economics. China's reopening. I feel like the consensus has been dead wrong every single year on every major issue. As we go into the third year of all of this, how are you thinking about that challenge as a policymaker? Is there something you're hesitant on drawing too many conclusions on too prematurely?
Right. I think we're normalizing, but you can't ignore the impact of the pandemic, that the pandemic is still having in the economy. Some of the things we've talked about, businesses reluctant to shed workers because of the history, shortages in switchgears and cabinets, $1 trillion plus in excess savings still out there, the infrastructure bill still being deployed. All of these things are, if I could call it, not normal, artificial things that are in the economy today that weren't in the economy 3 years ago. Now, for me or for us, you have to take it as a given. And so you try to make policy against the economy you've got, not the economy you wish you had. But I think for sure you've still got that in the economy.
President Barkin, thank you. You can do as much Fed speak as you like, just so long as it's like, you know,
right here.
With Mike McKeon.
We're every day.
I appreciate the time. Thanks for having me here.
Thank you. That was Thomas Barkin, the Richmond Fed president. Coming up, the market moving events you need to be watching. We'll get to the trading diary in just a moment. Live from New York, this is Bloomberg.
No one can claim that climate change is somebody else's problem or shrug it off for future generations to address. We're all affected by a warming planet. We see that every day. And decisions being made right now will determine our shared tomorrow. So we must choose, and we must act as united nations ourselves. Our progress depends on collective action, on collective ingenuity. If we stick together, we can make fixing the climate the greatest project and greatest achievement of our lifetimes. We have the science, we have the solutions. Now all the world needs is political will. Together, we can create a future where rampant carbon is removed from the atmosphere, where green buildings and green business transform the livability of communities.
This is Bloomberg.
Trying to manage markets, at least for me, is a fool's errand. And so I'm in the world of trying to manage what we can control. If demand stays hot, if inflation comes in elevated, have rates move more. The biggest surprise has been the jobs market. I mean, the jobs report we got a couple of weeks ago was quite significant and much stronger than what I had anticipated. And so the question in my mind is going to be, are we going to get another one like that in February, or are we going to get something in February that revises, corrects, moves it down? So I think that's really the key thing I'm looking at in terms of growth.
Fantastic to catch up with the Richmond Fed President, Thomas Barkin, there alongside Mike McKee as well. Just a little bit of response there to the CPI report we had about an hour and 25 minutes ago. Not much for market response, very jumpy in the minutes afterwards. Right now, totally unchanged on the S&P 500. On the Nasdaq, positive 0.2%, trying to build on the gains of yesterday's session to start the week. That's the equity story. Here's the bond market. Yields higher, particularly at the front end, by 6 or 7 basis points. Very close to 460 at 458 on a 2-year. Yields up 6 basis points. New highs for the year there. That's the price action. Let's get you the trading diary. Coming up, Fed Speak continues. Logan, Harker, Williams, all on deck. President Biden discusses the economy, 1:15 Eastern time. Retail sales tomorrow. Big data point for us to cover together. Jobless claims on Thursday. And finally, some more Fed Speak through the week. Mester, Bullard, Cook, Barkin, Bowman to close out a week. From New York, that is it for me. Thank you very much for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much like the consumer is paying them. And so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value and the kind of transparency that they want.
Are you seeing a labor shortage right now? And what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about like going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
To keep rain World Cup. This is a 3
as the economic picture does. The OK is getting ready to make
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we had mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi Number Fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's Number Fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning 1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as the coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be a ploy by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why he may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today. And then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the danger, the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake. right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance, is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
The Fidelities and the Schwabs and the E-Trades of the world, they look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
This is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't, and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech and write-up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I am about to lose everything.
And And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwit, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, the hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350.
Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit,